Yes, sir. What it do, team? What it do? Just tightening up things just a little bit. Tightening up things around here just a little bit. Just want to jump on, say what's up to the team. Y'all know I'm still here. Observing, watching, anticipating to deal with. Just got finished touching up on my weekly chart. Still in that controlled buying algo. Yes, we are. Still in that controlled buying algo. What can I do about that? And last week put in a beautiful hangman. Right now we have price trading above Friday's close. This is going to be a very irregular week. Very irregular week. I'm just getting on here, checking in with the team. But I have no intentions on trading today, tomorrow, or any day this week. This will be irregular activity, and I'm choosing not to partake in it in any way, shape, form, or fashion. Rather, I will be spending the remainder of this year in review. That's right, in review. Going over my setups, regrading them, reanalyzing them. As you can see here, as I show you that we are still in a larger controlled buying algo, even though we have come down from recent highs. Actually was, you could either view it as a double top or you could view it as a lower high, but where we have come down to is nothing but a natural breath that is being taken. It is of no way means that the bullish sentiment has changed, even with this pullback right now, as we currently are sitting at 684. We are still in this algo. So the big move will be the breaking and continuation on to create new highs, searching out for that 700 or the breakdown below the 6667. Either way, this is not a full week. A lot of people are on vacation. Big money is on vacation. This is not a normal week. There will not be any kind of normal trading. I will not put any money at risk in an unnormal environment. Rather, I will do something that is unnormal, and that is go back and review. Do my year-end review on my trades, on my setups, and even on my losses. see how, if I would have traded those now, how effective they would be. And that's the beauty of having your statistics. So if you are definitely following me and being a part of this journey, then I implore you, if you do not have them, get them. Go into this next year treating your trading like a business. For those of you who need tax help, I did not forget. I will have Brian on here very soon. For those of you who are profitable and who will need to claim gains tax. So that is definitely coming up. But again, I definitely implore you to start treating your trading as a business. And in doing so, you have to take account of what's hot and what is not. What's moving and what is not. Would love to compare what I've learned as far as by way of patience right now to activities of earlier this year. I'll give you an example, straight live example. I can go right into Google Docs, pull up Google Docs, and here we have a current December trades, but I can go all the way back to October trades, September trades, June trades, May, April, March, February, all the way back to January. Go pull up those trades and see exactly if I won on that trade, a picture of the trade, okay? The notes that I made, no pattern was present, the stock was trading within a controlled buying algo. There was no need to short this. Pattern, no pattern. The stock broke the controlled buying algo in an area of weekly support, but it was after 3 p.m., after a day of trending up all day. No need to short this. Trader error. So even in a loss, I detailed the mistakes that I made, where I got in, where I got out, what I lost on this trade, okay, percentage wise. And then I even have a photo of the trade, okay, where I can go back and review it and see my error, okay. Yellow means where I should have gotten in. Okay, see the error that I made, and then look at the notes all the way back to January. Okay, all the way back to January. Beautiful wins right here. I should have gotten it earlier. Okay, and I encourage all of you to have this where you have notes on your trades, accounting on your trades, where you got in, where you got out, okay, a copy of the trade, analytics of the trade, identifying what pattern was used on the trade, okay, all right, and spend this time in review so you can narrow down those setups that percent edge with you, and when you have detailed proof. Okay, I encourage everyone to do this. Again, January trades, February trades, and so on. March, April, May, June, the entire year. I document all of my actions and what I do. I saw right there, this is when, in March is when I stopped trading before 10 o'clock, started making a note of it. was noting that majority of my losses were coming before 10. So if I just eliminated that alone, it will put me in a much better situation. But this can only come about when you take accountability for yourself and accountability for your trading. What's working, what's not. And then more importantly, what is simply trader error? What is trader error? Meaning it's not your system's fault, it's your fault. It's not the setup, it's you. It's not what was present, it's what you did. And that is what we want to work on. So again, I just want to get on here, show love to the team. I have no problem keeping the chart up today. But I just want the team to know that I will not be trading at all this week. Not at all. It's an irregular week and an irregular time. Also at the end of the year, the end of the month. So we're not going to see anything normal. So the only thing I'm going to do here now during these days is review, review, review. In preparation of making 2026 my best trading year ever. And that's not gonna come by being in a hurry to trade. That's gonna come by being in a hurry to gather information. To gather information. Speaking of information, we've already identified the controlled buying algo that's coming right out of this morning pre-market. Went right up to the top of it here on the 5-minute chart and came down. It's coming down to a monthly area of support at the 683.4. Don't know what will happen here, but the algo has been identified. And again, I will not be trading at all. I will be reviewing. I will be preparing. I will be analyzing. I will be upgrading my system. I will be becoming more determined, more disciplined, saving more money for the key moves, the big moves, the give me's, the alley-oops, the can you believe this moves. I will not be forcing. I will be waiting, watching. And when the opportunity presents itself, then I will execute. I will do less trading. Be more patient. And when I do execute with more size. More size, less trades. T-shirts for trader. If you're on here, let's see if we can't get that on the shirt. More size, less trades. We don't need to trade more. We need to be sure that we know what we're trading. Still not guaranteeing that every trade is going to be a winner, but definitely guaranteeing that every trade is going to be worth it. The ones that we do take. Looking forward to that. Just want to get on here and salute you guys, show you how much I appreciate it trading with you guys for another year. This upcoming March will be our 3rd year. March will be year number 3 of going live. All you have to do is click on the channel, go up to the top where it has the playlist, click the live button, and you will see our very first live. And this March will be our 3rd year tuning in, being very transparent. Very excited. Very excited. Well, I'll talk to you guys soon. Big Ben in the building, BFH. For those of you who did not hear, I'm saying it again, Ben, because I see you just got on. But I will not be trading at all this week, not at all. I will be using this week to review. I will be using this week to prepare. I will be using this week to become more disciplined, more determined, more determination, more focused. I will be using this week to review my past trades. This is going to be a very irregular week. I will not be putting good money at risk during a week of irregularity, but rather I'll be adding that money to my trading account, protecting the money that's in the trading account, knowing that everything that's happening right now isn't going to mean anything come the beginning of the year. They're going to have to do it all over again. But I'm not going to get my money caught up in this foolishness. Yes, sir. But I'm going to leave the chart up, Ben. I'm going to leave the chart up for those of you who want to find profits in the chart, as there's always profits in the chart. But I will be preparing myself to make 2026 my best trading year ever. I plan to use more size and take less trades. The trades that I plan to take, you should be able to see from a mile long. That's how simple I'm going to get in this trading. Because the more we wait, the easier it is for us to pick the market apart. The more the market reveals to us. And we're going to use our strengths, that information that we have come across that has been verified. We're going to use that to our advantage. That's going to come about by being patient. First 5 minutes, very volatile. The first 15 minutes can trick you. Have you thinking the market's going one way and then completely go in a separate direction. Armed with this knowledge, we will act and trade responsibly. The goal is to make 2026 our best trading year ever. And that's not going to come by trading often. It's going to come by taking trades that are worth it. Enjoy yourself, everybody. Talk to you soon. I'll keep the chat open. Bye for now. Big Ben, I just seen that text. Oh my goodness. Please send me the address, whoever told you to do that, so I can go beat them up, teammate. I got your back, teammate. Whoever told you to do that, teammate, you tell them Abdul is coming. And I'm gonna get them for you, buddy.
store pickup, risk the delivery times at this point. So last minute shoppers are flocking to the app. For a while, it was well, but Target is really the one that's picked up in the last few weeks. It's done much better in kind of the shoppers' minds, or in their consideration set from Black Friday on, and it's in total app downloads, a spot it hasn't held at all this year. So very timely to be in customers' minds.
Yeah, Target's had a rough year. It's had arguably a rough couple of years here. You've got a neutral rating. Does this change your thesis on Target?
So the Target call here would be tactical. It would be, they might be having a nice holiday season. They started with commentary in 3Q. So back in November, they gave commentary that their toys were up about 10%. That is a very good way to start the holiday season, and the app downloads have been strong since. Our issue with Target is a bit more structural and a bit longer term. We think they're behind on investment spending. Their price points are a little too high for some of their assortment as well. So we think calendar 2026, after what could be a strong holiday season, you're going to have increased spending needs for Target, which is earnings risk for Target.
And Bill, now I know you've been negative, at least as of recently, on Costco. They don't really show up that well in these app download numbers that you mentioned. And it's always been an expensive stock. But what do you say to folks who argue that, it's kind of unwound that really huge ramp in its valuation that we had, last year and into this year, and it's kind of trading back to where it always has, and it's generally been, sort of reliable even in a value-centric consumer environment?
It's a fair place to start, and that's kind of where we started. It doesn't underperform too many consecutive years, right? That's very rare for Costco to underperform 2 years in a row, and that's what it would take for our call to be right here. But what's happening at Costco is a lot of metrics are going the wrong way at the same time. Renewal rates have faded a little bit. Incremental members added aren't as robust as it's been, and traffic has slowed. And when I think about what Costco does, and what Costco does very well, is they're better than every other retailer offering value. The parameters that consumers care about, value is one of them. It's convenience plus value. Walmart's doing both. Walmart does both very well. Costco does one of the two parameters very well. And that's been perfect during times of high food inflation. Being the best value-oriented retailer, that won for Costco.
Those of you
but
who
now
are
with food inflation at lower levels, and it's been at lower levels for a little bit, people, or at least incrementally, shift a little bit away from value and a little bit toward convenience. And that's, I think, the structural problem at Costco, is they're only offering one of the two parameters, and the convenience part, which they don't do as well, is becoming more important.
Is some of the weakness in Costco, is it picking up small business activity to some degree? I know that is a piece of their consumer set.
It is. I mean, they do a very good job. They have great assortment. They have unique assortment. They can kind of hit a lot of different consumers. But as things like Walmart.com become more pervasive with third-party sellers, right? Walmart.com all of a sudden can have a endless aisle, right? Endless assortment that can overlap with Costco better than the Walmart physical stores could for generations. So you're getting increased assortment overlap between Walmart, using Walmart.com, and what Costco can offer.
Bill, I'd argue that the same argument you're putting out there would pertain to some of the,
real estate, right? They have a lot of really good real estate, and they are a very good last minute shop. I don't cover them, so it's hard for me to specifically put it into the context. But yes, it would make sense.
And then just knitting it up on Walmart, I mean, does it all circle back to the advantages Walmart has that the market kind of recognizes at this point?
I think they understand it, but this is a generational change at Walmart. All right, so for years, Walmart's convenience was not a variable; it was a constant. They were great on value, but convenience didn't really change. Right? They tried the neighborhood stores to get into new markets, but they were kind of stuck with their very large format boxes and didn't have ways to go penetrate new areas. Right? They couldn't offer additional convenience. And with COVID pushing shoppers online in a much bigger way, that allowed Walmart for the first time to really go offer products to neighborhoods they never serviced, right? Their physical stores couldn't get into those neighborhoods, and now Walmart.com can. So there's a lot of small retailers out there that were lucky for decades to never go against Walmart that are now squarely in the crosshairs of Walmart.com. So this is a very new variable for Walmart. Convenience is something they can lean into that was not available to them before, and I think the market's just beginning to understand it.
Okay, Bill Kirk, thank you.
When we come back, the first state AI laws get set to go into effect, how this patchwork of new rules might impact business. Plus, venture capitalist Eric Capoz's with us today. Look at the IPO pipeline. Bill Ackman now trying to appeal to Elon Musk as SpaceX plans its potential public debut. So stay with us. Welcome back. New state AI laws could have major implications on the space. Emily Wilkins looking at how companies are preparing for those laws to go into
on the
effect
first
on
day of
January 1st. Emily.
Christmas.
Hey, Mike.
So
Yeah,
on
look,
the
major
first
AI
Bluetooth
companies, they're
disconnected.
getting ready for that California law on AI safety to begin to go into effect in just a few weeks. Companies with revenues of over $500 million, they would need to create a framework showing how they manage severe risks that their most powerful models could pose. And severe risks is defined as causing over $1 billion in damage or 50+ deaths or serious injuries. Companies are also going to need to start reporting events that pose major risks, like a system being hacked, and face fines of up to $1 million if they fail to report. Now, the law's implementation, of course, comes as President Trump signed an executive order meant to discourage states from implementing AI laws. arguing that a patchwork of laws is going to limit AI companies' ability to innovate and create new models. But that hasn't stopped California. At least one AI company, Anthropic, has already released their compliance framework, which, according to the company, describes how we assess and mitigate cyber offense, chemical, biological, radiological, and nuclear threats, as well as the risks of AI sabotage and loss of control for our frontier models. Now, California's bill is the first frontier risk bill to go into effect, but it's certainly not the only one. On Friday, New York Governor Kathy Hochul signed an even stricter bill into law. Companies would only have 3 days to report critical safety incidents, and fines would begin at $1 million. And we know from what we've seen in state legislatures this last time, guys, we can't be expecting many more state AI laws to come, even with the executive order that we've got from Washington, D.C. Guys?
That's exactly where I'm going with you, Emily, is how does the executive order change any of this, shape any of this, and perhaps just as importantly, is Congress working on anything from a federal and national level?
I mean, Sarah, I'll start with the second one first. No, I mean, at this point, we've heard Congress talk about wanting to do something, but as far as a piece of legislation that really has the momentum to address a lot of these issues and pass into law, we haven't seen anything yet. In terms of exactly how this is going to impact things, remember, the executive order didn't outright ban state laws. It basically gave the Justice Department the ability to go out and to litigate them, saying that if they impact interstate commerce, that's something that's supposed to be a federal role. So we'll have to keep an eye on exactly how the Justice Department responds to California's, New York's, any other state laws that we're seeing, and how the courts wind up deciding on that.
Yeah, Emily, I guess these laws initially, they apply to only probably a handful if those revenue thresholds are what you say. And I wonder if they're just, those companies will kind of just focus on maybe lobbying on the federal level to try and either supersede these laws or find ways around them.
I mean, Mike, we can say that these companies, they are on the federal level. They are also very much on the state level. It was very interesting with New York's law. They initially had a different bill pass the assembly, but then some last minute changes were made, partly that were lobbied for from groups like, say, OpenAI, Meta, Google, to try and get the New York law to be a little more similar to California's law. So there wasn't so much differentiation in how companies would have to report and what would report. Now, the two laws are not identical. There are some separations there. But again, this is why companies want to see a federal standard, because if New York and California has gone, it's very likely that other states are going to wind up going as well.
Yes, we'll see how far the one rule thing goes and relative to states' rights and so forth. Emily, thanks. Emily Wilkins. Let's get a CNBC News update this morning with Christina Partsinevelos. Hey, Christina.
Hi, Carl. Well, Australian police say the father and son who killed 15 people in a mass shooting at Bondi Beach conducted firearms training before the attack. The court documents also said the two men began their attack by throwing improvised explosive devices towards a crowd celebrating Hanukkah, but they failed to explode. Officers then injured the 24-year-old suspect at the scene of the shooting and killed his father. As the Trump administration continues its crackdown on immigration, the Department of Homeland Security is increasing its so-called, quote, stipend for people illegally in the country who self-deport. DHS says migrants will receive $3,000 through the end of the year and will be forgiven any civil fines and penalties. Instacart said today it is ending a program that showed some customers different prices for the same product ordered at the same store. Sources told Reuters last week the Federal Trade Commission is probing this practice. Instacart has offered the price testing service to retailers since 2023, but said today the program raised real questions and concerns and fell short of consumer expectations. It took 2 years to do so. Morgan, back to you.
I can only imagine. Christina Partsinevelos, thank you.
Thanks.
When we come back, venture capitalist Eric Hippo is with us. Why he says we'll have to see some, quote, sobering adjustments when it comes to private AI valuations and how that could impact the IPO market. Plus, could a 3-year high for one key metric signal the end of the freight recession? We've got that and more when Squawk on the Street returns.
We are 1 hour into the trading day. Some of the big stories moving the market so far. Cleveland Fed President Beth Hammack telling the Journal she doesn't think there will be any need to change rates for several months. Hammack citing concerns about elevated inflation. She wasn't a voting member this year, but she will be in 26. Gold's on pace for its 52nd record close of the year. The precious metal's on track for its biggest gain since 79. Expectations for lower rates helping to fuel that move higher. Silver and copper, of course, getting an even bigger boost as well. Shares of NVIDIA moving higher after a Reuters report says the company's looking to start shipping those H200s to China by mid-February. We'll get more details on that story coming up.
Been a pretty busy IPO year with 201 companies coming public in 2025 and raising $44 billion in proceeds. That's up over 48% compared to last year and is the highest amount raised since 2021. Still, there is a massive backlog remaining as disruptive tech companies like OpenAI, SpaceX, Anthropic, and others remain private. Let's bring in Lerer Hippo, partner Eric Hippo, to discuss what he expects for the year ahead. Eric, clearly there's plenty of companies ready, but do you really believe this is going to be a year of unlock in the public markets, given how easy it's been for these companies to raise capital privately and put their own values on things?
Well, good morning. We always hope that it's going to be the next year, but this year there are some really good signs. The IPO market, as you mentioned, is doing really well. The backlog is not going to be cleared all at once, but this is the best. This year has been the best year for IPOs since 2021, and there's good signs to say that it's spilling over into 2026.
And do you think that the AI-related companies can actually get big valuation increases if they go public here, or have they already kind of front-loaded a lot of that? I mean, even we talked about OpenAI raising capital at an $800 billion valuation. That's bigger than all but a dozen public companies right now.
Yes, we do live in some sort of a fantasy world when it comes to AI valuations, and we're early stage investors, and we feel it at the very early stages as well. The kinds of valuations that are being given to companies in the private market today in the AI field mean that there's going to be dozens, if not hundreds, of companies that are going to be worth $10 or more billion. That is not realistic. However, there will be some big companies that will emerge out of this. I suspect, however, that the first $500 billion IPO will not be an AI company, but will be SpaceX.
Eric, you just took the question right out of my mouth, because next year is poised to be a big year in terms of some big offerings, whether it's, and I know this is still speculation, but OpenAI or Anduril Industries, a number of others, but SpaceX, a possible $1.5 trillion offering. Is the public market ready for that?
I believe so. I think space. So if this year was the year for AI, the year for infrastructure investing in power and energy, was also the year that we saw robotaxis and robotics and automation starting to take center stage. I believe that next year will be the year of space. So that's the next big frontier. We're talking about putting data centers in space. We're talking about the next warfare to be done in space. So there's tremendous amount of activity going on in space with potentially huge rewards. SpaceX is extremely well positioned, if not in a unique position to capitalize on this.
Yeah, I would argue that it gets at an even broader trend here too, which is this idea of not only industrial AI, but AI-enabled hardware, which we're seeing both in space and on Earth. Your thoughts?
Yes, that's a big change, because what's happening in robotics, taking commoditized components, so in other words, components that are very cheap to produce and very easy to get, and we're putting an AI brain on them, and we're making and we're training them with visuals. It's so much easier to deploy them, to retrain them for new tasks. Robotaxis are a really, really good idea, a really good example of this. Both Waymo and Tesla, are unleashing these driverless cars that are enabled by AI and are much safer than human drivers.
Although, Eric, a lot of the coverage today is about the San Francisco blackout and these freezing Waymos and the traffic disruptions. Last week it was about the vending machine in the Wall Street Journal newsroom that was giving away stuff for free. Is this all sort of normal growing pains as the models improve?
Yes, it is. and I love the Wall Street Journal story. I actually had the robot went and purchased a live fish. So yes, we are. This is early stage. We're in the very early moments of that. But in the case of robotaxis, the data is in, and the data is very clear. Robotaxis are way safer than human-driven cars. And so that kind of safety aspect will permeate every aspect of robotics.
Eric, you mentioned you're more on the kind of early stage side of this. What are you mostly seeing in terms of opportunities, given that AI has been one of these movements where it seems as if the benefits of scale are massive, and it seems like the arms race in terms of how much capital you have to spend, at least on the model side, is vast. So what do startups have to contribute here, and what are they facing in the way of competition?
Well, there's two sides of it. One is most startups, as you might imagine, today have some sort of an AI component to them. But however, they are also using AI in an incredibly productive way, so that you have these startups that might have 6 employees, 10 employees, and they can get to millions of dollars in recurring revenues in almost no time whatsoever, because AI is giving them such a productivity boost. And this is a really good signal as to what's going to happen to the economy at large. This idea that AI is going to replace jobs. Well, Vanguard just came up with a major study that is showing that, in fact, it's creating jobs because it's being used as a way for humans, for people to boost their productivity, not to be replaced by AI.
Eric, the other thing that seems to be, I guess, poised for realization in 2026 is a full disruption of financial services and fintech, whether it's the adoption of blockchain and stable coins or AI for that matter. How are you thinking about that or assessing that? How would you be investing for that if you are?
Well, the first area that where stablecoins are playing a major role is in payments. Payments, particularly cross-border payments, are very painful today. They can take a week to clear. There's fees upon fees upon fees. And with stablecoins, you can basically close transactions in a secure fashion, sometimes in a matter of minutes. And so that's the first place where we're seeing stablecoins play a major role. I would imagine that that's going to start playing a domestic role as well, that our kind of financial infrastructure will be made way more efficient because of blockchain and stablecoins.
Yeah, that would be, I guess, a manifestation of a long-promised switch. Eric, thank you very much. Appreciate the time.
My pleasure.
And all the best in the new year. When we come back, are new signs signaling the end of the freight recession? We'll look at some key data along that front. Plus, coming up next hour, don't miss National Retail Federation CEO Matt Shea with no new numbers on holiday sales and the consumer. That's next hour on Money Moves.
Welcome back. Crude prices are up today amid reports that the Coast Guard is pursuing another oil tanker off the coast of Venezuela. That would be the third tanker seized in the last few weeks as the U.S. ramps up its political and economic pressure campaign on Venezuela and its leader, Nicolas Maduro. National Economic Council Director Kevin Hassett said on Sunday that the Americans shouldn't be worried that prices will be going up because of the moves, claiming that the seized tankers were, quote, black market ships. President Trump, Defense Secretary Pete Hegseth, and the Navy Secretary are scheduled to make an announcement today at 4:30 p.m. Eastern Time.
Which I will be watching and covering and bringing to you live in Closing Bell Overtime. In the meantime, could new data be signaling the end of a freight recession? Well, Frank Holland is looking into this morning. Frank.
Hey there, Morgan. You know, this could be the sign the freight recession is ending. Could's really the key word here, but the Sonar Truckload Reduction Index is at 13%, highest level since March of 2022, just before the start of the current freight recession that many see as the longest on record. So one reason for that spike, rising prices on the spot market. The latest read shows rates for general trucking is up 4.5% year over year, but that's the national number. In some regions, it's even higher. Some drivers are shifting their availability to avoid enforcement from the Department of Transportation. The DOT has, over the last year, reduced driver capacity by about 1% by enforcing English language requirements, and has also closed or sent warnings to nearly half of all trucking schools in the Federal Registry, claiming either they're providing insufficient training or they're investigating their training. Knight-Swift, the nation's largest full truckload carrier, said a few interesting things in its latest earnings. First, some customers are actually specifically requesting U.S. drivers. They also see private fleets declining. These fleets built up by retailers in some cases, and Knight-Swift is considering moving more of its capacity to the spot market to take advantage of rising rates. The stocks to watch in this situation, Knight-Swift, the aforementioned company, and J.B. Hunt, two of the biggest players in trucking. Also brokerage stocks, C.H. Robinson, Expeditors, and RXO, all three of them benefit from disruption.
Frank, given the fact that it seems like the spot rates are going up, as you mentioned, because of the supply reduction, what do we think about it as an economic indicator for growth next year?
Well, in all fairness, it's very early, Mike. This is the holiday season. We're towards the end of the year. Obviously, some people take vacations in trucking just like any other industry. So that's one thing to look at there. If this continues, though, the trend going into March, that's when a lot of big companies like a Walmart or Target, they actually contract their rates. If we continue to see rates going up, going into March, where they contract the next year of rates, well, that's a clear sign that the capacity situation has tightened and the recession could be coming to an end, because the truckers that are in service and have drivers available are going to see those higher rates. Does that mean that we're going to see more volumes? That's not really clear. I've spoken to a lot of transportation CEOs. They believe the AI build out and also nearshoring and onshoring is going to accelerate next year as well.
That's exactly where I was going to go with you, Frank. And on the retail side, when you think about inventories, we saw such pull forward amidst all the tariff uncertainty this year. There seems to be an expectation that we could see another surge coming into 2026.
You know, I've spoken to a lot of different companies about their customers and how they're seeing their inventory. Really a mixed bag. Some people are still doing just-in-time inventory, believing that they can get things into the country when they need them. Others are doing just-in-case inventory, and that's just what it sounds like. You're holding more things to anticipate supply chain disruption. So I don't think there's one uniform thought right now, other than you need to move more of everything you're doing here to the U.S. to comply with some of the pressure from the Trump administration, but also in some cases just to mitigate the cost from tariffs.
Huge implications, obviously, for transports, which have had a run of their own, Frank. Thank you, Frank Holland, today. When we come back, new reports say NVIDIA might start selling its H200 chips to China as soon as mid-February, but some major roadblocks still remain. We'll take a look at that next. Don't forget, you can now catch Squawk on the Street anytime, anywhere. Just listen to and follow the Squawk on the Street podcast. It's available now on Spotify, Apple Music, and more. We're back in a minute.
Welcome back. New reports say NVIDIA could start shipping its H200 chips to China in the beginning of next year, but some headwinds still remain. Christina Partsinevelos has that story for us. Hi, Christina.
Hi, Morgan. Well, NVIDIA told Chinese clients it aims to ship roughly 40 to 80,000 H200 chips. These are older but still powerful chips before the Lunar New Year in mid-February. This according to Reuters. That would actually mark the first set of deliveries to China since Trump approved the sales earlier this month. But I have to point out, nothing is certain yet. NVIDIA declines to comment. Beijing hasn't approved any purchases thus far, and Chinese officials are even considering requiring each H200 purchase to be bundled with domestic chips from Huawei and Cabricon. So that would actually force buyers to support local alternatives even as they purchase American chips. And the restrictions may be less airtight than they appear. The FT and Barron's reported over the weekend that Tencent is already accessing NVIDIA's more advanced Blackwell processors through a NeoCloud partner outside of China. Wedbush, though, says any resumption of China shipments would be, quote, meaningfully additive to NVIDIA's forward expectations, noting street consensus numbers have excluded any China revenue. The firm points out China represented over 10% of NVIDIA's sales in 2024 before the export ban, so China would be additive if they actually started to ship these chips. Shares are higher today, likely also driven by a Taiwanese report forecasting Grace Blackwell, the next generation server rack. Shipments would actually rise about 129% next year. In other chip news, Bank of America upgraded Intel to overweight, citing improved credit metrics, improved cash on hand, and lower exposure to AI demand cycle concerns. They also upgraded Micron, memory maker, to market weight, as the company can only meet half to two-thirds of demand from key customers, driving improved free cash flow. In other words, supply just can't keep up with demand when it comes to memory chips. So that's why we've seen the stock just surge 220% year to date.
Yeah, that B of A call was interesting in that they kind of prefer models that are, I think, credit light is how they put it, KP, given some of the concerns that have been creeping into the space basically through the credit markets.
Precisely, and Oracle is obviously a big thought for that, and the NeoCloud's getting hit, but Micron, I guess, has been very loved by the street because memory in general is cyclical, right? So this is now Micron's time to shine, that they're going to be sold out of supply even in 2026 based off of their last earnings call. So another incredibly bullish commentary, sell-side research, I should say, from Micron. Everyone seems to be bullish on this name.
Yeah. Oh, Christine, I just wanted to get your thoughts on the fact that it's NVIDIA. You have the reports about AMD, but meantime, in China, I mean, you had this blockbuster IPO from MoreThreads, which is, being called China's answer to NVIDIA, and speculation, or I guess reports, that some of the OpenAI rivals in China could start to go public next year, too. So just how to think about these supply chains and the decoupling.
Yeah, it's not even this. It's every single week there seems to be another massive IPO. There was MetaX not too long ago, which is a GPU provider. This shows that there's not only local appetite for these names, there's also, government support that's been going on for quite several years. So the decoupling is happening no matter what, which is why, from NVIDIA's perspective, AMD's perspective, from tech American CEOs, they want their stack, their product, to continue to be shipped to China so that they can stay in that market, when at the same time you have local alternatives that continue to grow. They're still not at the same level in terms of technology, but they are growing, and the gap is definitely shrinking between what's available here and what's available there.
Yeah, I mean, no doubt. Obviously, NVIDIA wants to maximize when they can and remain kind of a global standard. But I wonder, just watching how the stock trades with regard to a lot of these China headlines, Christine, I wonder if it's kind of, delinking a little bit to the China piece of the story, because, the OpenAI raise maybe has more to do with NVIDIA's next move. Plus, if they're giving 20% of revenue to the U.S. federal government, it also kind of blunts the impact of those sales.
I thank you for bringing that up, because I don't think it gets mentioned enough, and I should have mentioned it earlier. So NVIDIA agreed to pay a 25% fee to the U.S. government for these more advanced H200 chips. The same applies to AMD and Intel. We're not sure yet if it's anywhere between 15 and 25%. It is also assumed that at this point, these chip makers have not actually paid that fee just yet, but our AMD CEO Lisa Su said just a few weeks ago that they are willing to do so. By the way, to your point, Morgan, AMD did receive licenses for their version of their China chip. There's some rumors that, Alibaba's interested in buying it, so that's helping possibly AMD in Q4. It's not included in guidance, but just, Mike, to your point, everybody has kind of factored China out of the equation, so this would be definitely additive to both AMD and NVIDIA should they start shipping in 2026.
Yeah, bonus opportunity, as Jensen said on our air just a couple of weeks ago. Christina, thanks. Christina Partsenevelos watching Chips at Large. Coming up at the top of the hour, Charles Schwab, Chief Investment Strategist Liz Ann Saunders on why she says more dispersion in the Mag 7 is still ahead when Money Movers begins. Good Monday morning. Welcome to Money Movers. I'm Carl Quintanilla with Mike Santoli here at Post 9 of the New York Stock Exchange. Today, 2025's deal-making boom with tech driving the wave. We're joined by a top corporate deals attorney who says it's set to continue in the new year. He explains why he thinks it should be called M&AI.
Plus, Waymo's weekend blackout in San Francisco as a power outage disrupted operation of its robotaxi services. We'll dig into what the confusion signals for the scalability of autonomous driving more broadly.
It's crunch time for retail as some data suggests that maybe early holiday shopping was a little softer in brick and mortar. We'll get the latest read with the president of the National Retail Federation later this hour.
Right now, markets holding on to solid gains. The S&P 500 up just under 0.5%. The Nasdaq up a similar degree. The Russell 2000 outperforming as some of the sort of racier, more speculative stuff is on the move this morning. 10-year Treasury pretty steady, 4.16%.
Let's begin with the Fed today. Cleveland Fed President Beth Hammack making some comments on the path ahead for rates. Our Steve Leisman has that for us. Morning, Steve.
Morning, Carl. Yeah, the Cleveland Fed President laying out a hawkish outlook for rate cuts that, in the context of market pricing, not especially hawkish. I'll walk you through it. She told the Wall Street Journal she prefers holding rates steady till the spring. November CPI, she said, likely understated inflation, and the neutral rate could be higher. Now, these would have been more hawkish remarks before the last Fed rate cut, but now they're nearly in line with market pricing. Take a look. there's only a 20% probability of a Fed rate cut priced in the futures markets in January, 50% in March. The next cut doesn't become more confidently priced in until April. Well, April's the spring. A higher neutral rate is potentially hawkish, suggesting Hammock maybe not on board with the current pricing of the funds rate moving to 3% by year-end 2026. But a lot's going to depend on the data and maybe even more on who the president appoints as chair. The extended search for the next Fed chair reaching the end game with 4 remaining candidates. People familiar with the situation say the president could name the new Fed chair by the first week of January after interviewing the last candidate, Rick Rieder, in the last week of the year. Been pushback on Wall Street against NEC Director Kevin Hassett, the favorite, as reported by CNBC, the FT, and Politico. Concern Hassett is not seen as independent enough from the president, but the Treasury Secretary, he's pushed back on that criticism, and Hassett, once again, the clear leader in the prediction market. Still, an interview and perhaps plenty of politicking to go, but most people see this as a choice the president's going to make on his own, guys.
Steve, I know you tried to get them to tell you who the front runner was in your scoop last week. Any progress on that front?
Not particularly. It's very interesting. And what I've been also puzzling over, Carl, is who is the Treasury Secretary favoring here? And it's very hard for me to figure that out. He wrote that big story in International Economy magazine that sounded a lot like some of the reforms that Kevin Warsh wants to bring to the Fed. So that made me think, oh, he's for Warsh. Then there was all this pushback against Hassett. And the Treasury Secretary came in and kind of favored Hassett. I think what Bessent may be doing is just sort of keeping the ship on course of all these interviews. Remember, the interviews were canceled, then put back on. So I don't see who the favorite is other than, you know, the idea that the president said he knows who it is and that everybody thought that was Hassett. There was a lot of back and forth now, and looks like Hassett's in front. So who am I to say the markets have it wrong?
Well, yes, although the markets haven't been exactly resolute in deciding who it thinks is going to get the nod. Steve, I wonder if this sort of lack of apparent preference that you cite from Treasury Secretary Bessent is more about, look, he's gotten the message out there about what he'd like to see the person in that role do, and therefore that tells you the formula for what you'd have to say to get the nomination, and maybe it's all going to work together. Meantime, the Fed's already cut 175 basis points from the highs, you know, and almost anybody in there is figuring maybe just a couple few more.
You know, I like that formulation, Mike, as a way to think about, you know, the framework that's being adhered to here. Bessent has made clear the reforms he wants at the Fed. He's got candidates in front of the president, more or less, who would affect those reforms one way or another. So now it's like, and Bessent knows that the president's going to make his own choice. There's a little bit of politics in this, Mike, which is worth thinking about. Bessent hears pretty regularly about the president's criticism of his predecessor, Steve Mnuchin, who gave him Powell. The president doesn't like Fed Chair Powell. Wall Street likes Fed Chair Powell, I think. So I think the current Treasury Secretary is trying to be like, hey, this is not going to be my choice. I am not taking the blame on this one.
That's right, yes. Because typically, almost no matter who the Fed chair is, somebody wants to blame him for something down the road.
That's what they're there for.
Yeah, exactly. Exactly. All right, Steve Liesman, thank you very much.
Thanks, Mike.
Now on to the broader markets. Joining us now is Charles Schwab's Chief Investment Strategist, Liz Ann Saunders. Liz Ann, great to see you. We're finishing up a third straight, very rewarding year for U.S. equity investors. What's your kind of headline message to them in terms of what ought to be expected in 2026, and what are the key themes they should focus on?
Well, not that history ever serves as a perfect guide. I love Warren Buffett's quote about if predicting market returns was just about history, then librarians would be the richest people in the world. But if you do look back at 3 strong or up years in a row, more often than not, they're followed by another decent years. I think it's going to be a choppier pattern, though, but what I think will characterize 2026 more than just maybe up or down is pretty swift rotations under the surface. And that's something that really started to bubble up over the past couple of months. And you've seen leadership shifts that are pretty remarkable. And I think that's likely to continue. I think it sets the stage for a more level playing field for active relative to passive, and for equal weight relative to cap weight, and for opportunities down the cap spectrum, but not in a linear fashion, I think, in fits and starts.
Yeah, I guess the sort of leadership shifts you refer to in the last couple of months is probably, somewhat away from the mega cap secular growth names and toward more cyclicals, right? So financials and other parts of consumer cyclicals and things like that. Is that a trend that we should extrapolate into next year, or do you think it's just going to be kind of continually passing the baton?
I do think that there are probably legs to some of the recent leadership areas like healthcare, maybe in financials. But what's also interesting is that even within the broader technology space, and I'm not just speaking specifically about the tech sector, but the broader tech space, sometimes those stocks fall into communication services, you're seeing a broadening out there too, and not necessarily to the kind of newbies on the block. You've got the Western Digital and SanDisk and Seagate in the top 5 best performers year to date. So you're seeing more dispersion within sectors and even within cohorts, within AI-related cohorts. NVIDIA is still the #1 contributor to S&P returns, but that's a function of the multiplier of its size. It's actually ranked, I think, 83rd in terms of price performance on a year-to-date basis. So I think that's another thing that's really important for investors to understand, is not to conflate contribution to cap-weighted returns versus price performance. I think from a price performance standpoint, there's a growing kind of pool of opportunities.
Lizanne, talking about healthcare, it was hard not to notice the president call insurance companies fat cats on Friday night. And I wonder, in these spaces where margins have been robust, or at least pricing has been robust going into midterms, is there a reason to be cautious about some of those sectors going into at least the first half of next year?
Well, I think that there is the political angle to thinking about the market from a sector, from an industry standpoint, whether it's just rhetoric coming from the administration or actually proposed policy changes. I think that is one of the factors that will be a volatility driver. I don't expect to see a significantly volatile year in the aggregate and in a linear fashion, but I think we're going to have bouts of volatility, some driven by the traditional fundamentals of earnings season and you beat or miss on top line or bottom line. I think there's going to be a lot of focus on profit margins and actual productivity statistics, but that political angle, either taking stakes in companies, which seems to be part of the mission, continued mission here, or sort of bashing companies or industries, you can't not have that as a component of the volatility driver equation.
Meantime, Goldman points out almost every major equity market around the world has outperformed U.S. in local and U.S. dollar terms. Yep. You think that repeats in 26?
I think that does have legs. We always caution about doing too much of an apples-to-apples valuation comparison. You certainly could have done that, and that would point you toward non-U.S. markets because of a pretty significant valuation discount. Ultimately, though, what matters is what's the underlying driver of each economy. That sort of dictates what an appropriate valuation. If you're a innovation and tech-driven economy like the U.S., that affords you in general a higher multiple than, say, a country that is primarily resources, or a country like Germany that is basically an auto ETF. So you do have to do that industry-related comparison. That said, in the aggregate, the trajectory for earnings actually looks fairly healthy outside the United States, and where there is strength in pockets of those earnings happen to be areas that dominate the industries of many foreign markets, not to mention the fact that you tend to go in multi-year cycles of U.S. dominance from an equity market perspective to an era when you have increased opportunities both in the developed markets and the emerging markets. So we do think you want to continue to have that international diversification, and you no longer have to say, I'm sorry about recommending international diversification. You can say you're welcome.
That's right, because they've won 1 year in a row, at least at this point, Lizanne. As the aggregate outlook among your peers kind of coalesces here, it's striking, well, one, it's net bullish. That makes sense. But also that there's really a tolerance, it seems, for the current valuation levels. I mean, nobody's really saying, oh, valuation's going much up from here. But I guess when, the Fed is maybe tilted a little bit lower and there's no visible risk of recession out there, somehow we can hold these valuations for longer?
Yeah, I think we can hold these valuations, but an interesting thing happened over the course of the second 2/3 of the year between April and August. So that early April post-Liberation Day low to August, you did see a significant expansion in multiples. Now, earnings estimates were rising alongside it, but the trajectory of multiple expansion was greater than the trajectory of earnings. But since August, you've kind of been in this somewhat choppy, flat pattern from a multiples perspective, really at the point that started, suggesting that earnings were going to have to do more of the market's heavy lifting. You couldn't rely on multiple expansion to the same degree you had off the launch from early April. But the trajectory of earnings, both existing earnings and expected earnings, has continued to go higher. So the earnings outlook is doing the job in an environment where the market perceived multiples as being a little bit stretched. So as long as we don't see a deterioration in the outlook for earnings in 2026, I think we could continue that pattern of no overt multiple expansion, but earnings growing into that multiple.
Yeah. Okay. So time for the denominator to do the job.
Yeah.
Lizanne, great to catch up with you. All the best.
You
Happy
guys
holidays.
too. Happy holidays to you too.
Still to come this morning, we will speak to Hogan Lovells, global head of M&A, on his deal-making expectations for the new year and which sectors might see the most activity.
And later, National Retail Federation CEO Matt Shea is with us. The NRF expecting retail sales to exceed $1 trillion for the first time this holiday shopping season. Money Movers, be right back. Some breaking news on Alphabet. Deirdre Bosa has that story for us. Hi, Dee.
Hey, good morning, Mike. So Alphabet is acquiring Intersect for $4.75 billion in cash and debt. And this is a move aimed at locking down power and data center capacity, of course, as demand for AI surges. Shares are up about 0.5% on that news, session highs. Now, Alphabet already owned a minority stake in the company. The deal brings Google control over multiple gigawatts of energy and data center projects already tied to its infrastructure build out. And guys, this really gets at a key question in the AI trade right now. Where do the hyperscalers get energy to power the next wave of data centers? We know that they're increasing CapEx. They're spending a ton of money on this, but chips are no longer the only constraint. There's power, there's permitting, there's grid access. So this is really Alphabet moving to secure its own supply. And as I mentioned, investors seeing this as a positive, at least initially. Shares are up about 0.5%.
That's a big statement there. Yeah, thank you, Deirdre Bosa on Alphabet. Meantime, Paramount Skydance amending its offer today for Warner Brothers Discovery amid this bidding war with Netflix. Paramount now guaranteeing the backing of billionaire Larry Ellison. Ellison agreeing to provide $40.4 billion of the equity financing for the offer and any damages claims against Paramount. While Paramount's bid remains at $30 a share, it did increase its reverse breakup fee to match that of Netflix. Redbird's Capital founder and managing partner Jerry Cardinal was on Squawk today, talked about the deal.
When we talk to Warner Brothers shareholders, they point out two things. One, why is this so hard? It seems pretty straightforward. And two, why would they go exclusive with Netflix so quickly when you see these two offers lined up next to each other? We still have not been able to talk about shareholder value here. We're talking about all these other things. And so what we've done in this amended filing is we've cleared the brush on all the obfuscation around the offer.
Tender goes to January 8th, but they're definitely taking this to shareholders.
Yes, for sure. And interesting, no change in the value. So they're kind of looking to go kind of down the checklist of objections that some of the Warner Brothers Discovery representatives had cited out there. I don't think anyone doubted, the Ellisons had the money, it had to be in the right place, in the right structure. Also, maybe worth thinking about, even though it's $200 billion or thereabouts at current market values, it's down by close to half in a few months because of how Oracle shares went up so much and then rolled over.
All right. Kind of brings us to the broader M&A landscape and what to expect from deal making in 2026. Joining us here at Post 9 this morning, Hogan Lovells global head of M&A, Bill Curtin, is with it. Good to see you, Bill. Welcome.
It's great to see you, Carl. Good to see you, Mike.
We talked about media here, but you think A&I will be the locus of activity?
Yeah, I think we're going to have a year where we rename M&A to be M&AI. I think that's what's in front of us. By the way, I think Jerry put it exactly correctly. When you look at clearing away the obfuscation in the marketplace, that's where we are right now with M&A, right? We've got a very defined, predictable set of boulevards in front of us, right? We've got financing costs under control. We've got inflation that's cooled sufficiently. We've got low corporate tax, and we have predictability with regulatory side. So that opens up our avenues to go forward and do a lot of it.
Is it predictability in the regulation side when you got the president commenting on CBS and then stories getting spiked? What do we make of that?
Well, what I make of it is I listen to the chair of the FTC, the leadership in the FTC and the DOJ, right? And so when FTC Chair Ferguson comes out and says, look, our approach at the FTC is to get out of the way and get out of the way quickly when we can clear deals. It doesn't mean he'll clear every deal that comes his way, but there's a presumptive approach right now with the FTC and DOJ to try to allow M&A activity to move forward. Sometimes with structural remedies, Carl, sometimes with behavioral remedies, but not to avoid a no that we experienced so many times under the Biden administration.
When you talk about M&AI, what does that actually look like in practice? In other words, is it companies, kind of legacy companies buying their way in to kind of access the growth, or is it, consolidation within the AI sector?
Well, it starts with the notion that people can't get where they want to get in AI organically. So M&A is a non-organic tool. It's a big propeller, right? It's when you don't have the resources, the technology, or the financial position to get where you want to get. So it starts with that. Then you have the imperative when you look at your neighbors and see what they're doing in the space. And you bundle all this together and people go hard on AI. They go hard on AI technology and resource and know-how. And then as we just heard from Deirdre, they have to go hard on the underpinning, right? The power, the storage, the capacity that will fuel the AI boom that's coming. The ROI piece, where AI is really going to take us, that's beyond my reach and beyond the reach of a lot of my clients even. They just feel the imperative because M&A is such a psychological thing, right? A fear of missing out. And so they deploy us to execute what they cannot do themselves organically.
Is M&A, you think FOMO is a big driver of M&A right now?
M&A is an incredibly psychological experience. Back to what Jerry Cardinale just said, right, about obfuscation, about opacity. This is about keeping stride with your sisters and brothers in the marketplace, right? And what had happened in the prior 4 years is we had been checked and inhibited by unpredictability and uncertainty on the regulatory side, in the economies, and that had held back. And you hear about dry powder in the private equity markets, for example. All that dry powder is because people had been held back. That's now been unlocked broadly, right? Because we know that we can clear our deals, often with remedies. We know we can get the financing, right? We know we can put together a reverse break fee on a mega transaction. And that's why we're at record-breaking levels right now of mega M&A deals. The volumes will come. On the value side, Carl, we're in places that we haven't been before, and I expect that to continue in 2026.
So you think we continue to get the big ones, but they'll be followed by a larger school of the small ones?
That's exactly the point. That's exactly what I think. We've had in 2025 a remarkable run of mega deals. We describe mega deals as deals valued at over $10 billion. Well, we've had 5 at over $50 billion, right? We've had the most active Q4 for mega deals in history already, and we're not even finished. I've got another intense week in front of me of doing deals.
And that's
right?
with the shutdown.
That's even with the shutdown. So it's quite remarkable, but that's because of a lot of the inhibitions were unlocked and there was a lot of pent-up eagerness and zeal to go forward. And so everybody has really wanted to rack on and move forward with doing transactions. The mid-market, Carl, will follow, right? And that gets back to the fear of missing out and the general momentum and psychology of M&A that will follow.
If we have this presumption now that the FTC, for instance, is not going to stand in the way, and presumably DOJ either, what types of deals have been forestalled or people haven't tried to get done? Is it just like the big horizontal consolidations or other things?
Yeah, it's typically been the horizontals, but we're also able to get vertical transactions done now too, right? And historically, vertical was more difficult than the horizontal. But now we're seeing in both ways we can accomplish transactions, and that is incredibly encouraging for people, particularly in the technology sector, the energy sector, natural resources, specialty materials, all the pieces that are going to support and fuel the AI boom that is upon us. So I really expect, sometimes people say to me, Bill, what do you expect to see sector-wise? And I sort of say, well, there's 14, 15 different sectors that we talk about every day on CNBC, but there's really one sector, and that's technology. Right, because technology runs through every single sector that we work on. So I expect a lot of work in technology coming in front of us, but also in energy and natural resources. And I also wouldn't forget the consumer, right? I think you're going to see more in the industrial space with the reshoring that's come out of this administration. It's a very politically important piece to the puzzle. So I do think you'll see more activity, particularly with all the investment that the Trump administration has been able to secure into the United States.
So what's left in terms of gating factors? Is it price?
Well, if you think about where you open this segment, right? When you're a board and you're looking at an M&A opportunity, you always force rank it as value first, deal certainty second, and something that gets underappreciated is good stewardship. What will the buyer do with the assets that the buyer acquires, right? What will happen to the employees, the technology, the position in the marketplace? So value will be a key driver, and of course, when you have a boom, things get more competitive and things get, guess what, more expensive. So you'll see more mixed consideration, not just all cash transactions, Carl. You'll start to see some stock and cash deals. As Jim said earlier this morning, you're going to see some take privates where people are thinking, hey, financially, we're going to take this company private, stay off, not be in the public sector.
Well, Jim's point was that it was largely about model shifting in an AI age where you just can't put up with the impatience of public shareholders.
And I think he's right.
You think that's true?
I think his observation was astute, where he said the quarter-to-quarter life cycle, the instantaneous gratification that we've put ourselves in, was creating a strain for people who are trying to do transformative things through AI. Those are not just bolt-on transactions. They are transformative transactions. So I actually think Jim made a very astute point, as he often does.
You think the early part of the next year will be more active than usual, or is it back half loaded?
No, I think we're going to, as I said, I think we are going to rack on right into Q1 of 2026. And I would just say fasten seatbelts, chin straps on, because 2026 is going to be a big year for M&AI.
Bill, it's good to have you. We'll see what happens. Thanks for joining us.
Happy holidays.
All right, still ahead, OpenAI is getting more efficient at running its AI. We'll take a look at the efficiency gains next and how they stack up against the competition.
Waymo resuming service now after those disruptions after the San Francisco electricity outages over the weekend. We'll bring you that story and talk about whether robotaxis can truly scale beyond mapped out cities when Money Movers continues.
Welcome back. OpenAI is getting more efficient at running its AI. Our Mackenzie Sigalos has that story for us. Hi, Mac.
Hey, Mike. One of the biggest questions for OpenAI right now is whether it can make ChatGPT profitable at scale, and that comes down to how efficiently it can run the models. A source close to internal financials tells me OpenAI's compute margin on paid products, we're talking both ChatGPT and the API, jumped to about 70% in October, up from roughly 52% at the end of last year, and about 35% back in January 2024. Now, they're attributing it to a year-long efficiency push, squeezing inference costs, keeping GPU capacity tighter, and routing traffic to the right models so that expensive compute isn't wasted. Now, the contrast with Anthropic is striking. The information reported they started last year around negative 90% on compute margin, but its internal projections suggest it could eventually beat OpenAI on total server efficiency once you include training and the cost of serving free users. And that's the pressure point for OpenAI. The free user base is enormous. And even at around 70% on paid products, that's still well below the kind of margins you see at mature software giants, where adding another user, even a free one, costs very little. Which brings you straight to the funding question. Reuters reporting that SoftBank is pushing to close that $22.5 billion commitment to OpenAI by the end of the year. And they're doing that by raising cash, selling investments, and potentially pulling on undrawn margin loans backed by its stake in chipmaker ARM. OpenAI, remember, is one of SoftBank's biggest all-in bets yet. SoftBank's already liquidated its entire NVIDIA stake, trimmed nearly $5 billion in its T-Mobile US position, and cut headcount, all to fortify their posture in the AI arms race. Guys?
So, Mac, the efficiency gains that OpenAI is talking about here, right? It's trying to get more out of, every unit of computing power. I assume that also would translate back into, therefore, needing less power per search and per unit of whatever they're delivering. I just wonder if that's going to be the battlefront in terms of all these models, and maybe we don't have to extrapolate the massive power usage numbers that we've been seeing.
So there are a couple of factors that play on that front. So one, we talk a lot about the compute build out in the context of creating this fresh infrastructure. That's where that $1.4 trillion spending commitment from OpenAI comes from. And that's where a lot of these power concerns are derived from. But part of what led to this higher margin is the fact that the cost of renting GPU capacity has dramatically come down this year. And that's part of what led to these healthier margins for them on compute. And then, the other side of this, Mike, is the fact that the GPT-5 model, a key feature of that launch was the router, and people complained a lot about it, but it's a big reason that the compute margin moved higher because it routes traffic to the cheapest model that can still do the job.
Got it. Okay, so it isn't necessarily just that somehow they're able to use less juice. Mac, thank you very much.
Let's get a news update this morning with Christina Partsinevelos. Hey, Christina.
Hi, Carl. Well, the Trump administration today paused leases for 5 wind farms under construction off the East Coast, citing unspecified national security concerns. President Trump has long railed against wind farms, calling them ugly and cost prohibitive. The decision leaves just 2 wind farms operational in U.S. coastal waters right now. Officials in Greenland and Denmark reacting angrily today to President Trump's appointment over the weekend of Louisiana Republican Governor Jeff Landry to be a special envoy to Greenland. Landry wrote on X that it was an honor to serve in a position to help make Greenland part of the United States. In a joint statement, Denmark and Greenland's leaders wrote, quote, "You cannot annex other countries." Volkswagen will stop shipping its retro electric bus, the ID. Buzz, to the U.S. next year. EV sales have tumbled since the expiration of federal tax credits here in the U.S., and the Buzz launched just about a year ago, but sales have been slow, with dealers and customers complaining about its starting price of $60,000 and a range of just around 250 miles on a single charge. Still, the original version is very, very cool, Mike.
Yes, it's remained cool. Also some cool ads for that one, but I guess didn't really do the trick. Christina, thank you. Still ahead, it's the final few days for holiday shopping. NRF CEO Matt Shea joins us next on the strength of the consumer this season. He expects more than $1 trillion in sales for the first time. We'll be right back.
Crypto Watch is sponsored by Crypto.com. Crypto.com is America's premier crypto platform.
Welcome back to Money Movers. Retailers bracing for the final stretch of the holiday shopping season. This year is expected to be a record period for retail sales, according to the NRF, with spending expected to exceed $1 trillion for the first time. NRF also confirming the turnout this last Saturday likely hit a new high of nearly 160 million shoppers, exceeding the previous record in 2022. Joining us this morning is the president and CEO of the National Retail Federation, Matt Shea. Matt, welcome back. Good to see you again.
Good to see you, Carl. Thank you. Happy holidays.
Same to you. We've been checking in with you as the season has progressed. Any reason to think your forecasts have been thrown off track?
Carl, we feel very good about the forecast of growth exceeding $1 trillion for the first time ever. Growth over last year between 3.7 and 4.2%. So I think we got off to a great start on Thanksgiving weekend, those 5 days, that holiday period. We know we had a record number of shoppers out, 203 million, which was really outstanding. There's always a little bit of a lull between Thanksgiving and the middle of December, close to the end of December. And we see a big pickup at the end, as we did this last weekend, Super Saturday. We had an extra day getting up to the Christmas holiday. So there's still some shopping to do. But even in early December, consumers were telling us they had more than half of their shopping remaining. So there was a lot left to do before the season ended, and we're still confident we're going to hit that number.
Yeah, our viewers might be familiar with the historical spending trajectory. Kind of looks like Batman ears or Double Top, where you get your Black Friday, and then there's, as you said, the period in between, and then the final rush. Is brick and mortar holding up amid the growth of online?
Yeah, I think what we're seeing, Carl, especially we see over this last weekend, is consumers are shopping across channels. So now they know they've only got a few days left. They're close to the end of the holiday season. They're looking for the special gift or for that particular deal or for the value. So they're going across channels and across brands, but they're online, they're on their mobile devices, they're in stores, and they're kind of across all those devices and all those experiences. And we're seeing consumers, I think, respond to that very, very well and bring that to life for consumers so that they've got a range of options to try to find that gift before the season's over.
Matt, this theme of the value-seeking consumer is kind of happening at the same time where, of course, all the retailers have had to figure out exactly how they were going to navigate the tariff impact. And where does that leave your members? And are they able to get through this year and feel as if it's a kind of a cleaner slate into next year? Or, does the remaining tariff uncertainty still stick with us?
Yeah, Mike, I think the word uncertainty is maybe the definition of 2025. And certainly if we were talking back in April and May, I know I would have had a different expectation for the way the year was going to go on. I think consumers have been remarkably resilient throughout the uncertainty that's going on. And I think retailers have been really remarkably creative in delivering affordable, reasonable, resourceful solutions for their consumers. And we're in a very different place now than we thought we might have been 6 or 7 months ago. There's still lots of things we don't know about what might happen in 2026. And I think what I hear from the CEOs that I talk to, and I talked to some this morning and over the weekend, across industries, across segments, everyone would just like some certainty. We need a roadmap, we need guidance, we need predictability as we get into 2026. Highly complicated supply chains. It's very challenging to forecast demand in this environment. You're trying to operate very, very efficiently, deliver value for consumers, and consumers have enormous amounts of information now, lots of transparency out there. So it's a highly competitive, low margin business, and the uncertainty just makes it even more challenging. So I think we hope 2026, our wish for 26 is more certainty and predictability.
Right. Well, Matt, I'm not so sure. I mean, you may not want to talk about individual members, but certainly we have talked about Costco angling for refunds if SCOTUS rules against the emergency tariffs. How, as a group, will the retail industry react if, in fact, SCOTUS does rule that way?
Yeah, I think that's one of the pieces of information we're waiting for that might happen in the next 10 days, might be the first half or before the end of January. And again, I think the roadmap we'll get from the Supreme Court, one way or the other, will dictate how we go forward. Individual companies are making their own decisions about what they need to do to protect themselves or prepare for every potential outcome. I think we've done multiple conversations about this with our members and with retailers across the industry and consulted legal counsel. Everyone wants to make sure they do things the right way, again, depending on what that outcome is. And I think we feel confident that the case law, the Supreme Court precedent history is well established, that if the Supreme Court rules against the imposition of tariffs as they've been imposed using this particular law, IEEPA, whatever, a duty, a tax, a fee, a payment, if it's done illegally, you're entitled to a refund. I don't think there's any ambiguity about that at all. But again, some are taking the belt and suspenders approach for various reasons, perfectly reasonable, understandable why you would. At the moment, we haven't taken that action, and so we'll continue to talk to the members, and we'll see what they want to do, how they want to give us guidance, and we'll wait for the Supreme Court to rule.
Wow. That's actually a more fulsome answer than I thought you were going to give, Matt. Very nice.
Transparency is the watchword.
Yes. Yeah. Happy holidays. Can't wait
Thanks,
to talk
Carl.
some tax refund season in the weeks to come. Thanks.
Look forward to it. Thank you.
Matt Shea.
All right, still ahead, Waymo facing disruptions from a major outage in San Francisco. We'll bring you the details next and discuss whether robotaxis can truly scale beyond mapped out cities. We're back in a moment.
Waymo service is back up in San Francisco after a weekend blackout exposed what might be a blind spot for the rapidly expanding robotaxi company. Our Deirdre Bosa tells us why in today's Tech Check. Yikes, how was it, Dee?
It was interesting. Let me just show you some of the scenes from Saturday night here in San Francisco. You had Waymos stopped in the middle of intersections, causing gridlock across parts of the city. Now, the vehicles are designed to handle dead traffic lights and keep driving even if they lose wireless connectivity. But what you're seeing here is a system that defaulted to extreme caution when too many variables broke at once. Now, this raises a bigger question for the Alphabet subsidiary. Can they generalize? Because the ability to adapt in real time, that's what ultimately unlocks scale. And it may be the key divide between the Waymo and Tesla approaches. Now, Elon Musk posted over the weekend that Tesla robotaxis were unaffected by the power outage. Now, that is not a fair comparison because Tesla does not run a driverless service here in San Francisco, but it does reveal a different underlying philosophy. Tesla is trying to build autonomy that behaves more like a human, so one that can improvise, which can infer amid ambiguity, like in a blackout. Now, here's a simple way to think about it. A Waymo robotaxi approaching a dead traffic light treats it as a four-way stop, then proceeds very cautiously until it can confirm what every other actor is doing. So during a citywide blackout, that quickly turns into gridlock. A more human-like system, which Musk says Tesla is building, would do what drivers actually did that night, and that is read eye contact, edge forward, make judgment calls without having perfect signals. Now, the latter may come with safety trade-offs because it is asking the system to make judgment calls with less certainty, so learn in the wild. If that works, it could scale faster because it doesn't require perfect mapping before every deployment. Now, Waymo has the momentum right now. It is raising new capital at $100 billion plus valuation, is expanding to new cities. Now, the company says that it focused on rapidly integrating the lessons learned. That's what it's doing going forward. But this incident, guys, it really puts a spotlight on whether scaling, which is what this race is all about, means careful city-by-city expansion or systems that can adapt in real time.
I guess the one question would be, maybe the more adaptable system, the improvisational approach that Tesla is talking about would allow it to scale better if those cities permitted it, right? I mean, is that going to be a barrier to how the authorities decide whether they want those robotaxis on the road?
Right, and that is sort of the trade-off that Tesla is making, right? It's more of an improvisational situation or strategy, so cities are perhaps a little more reluctant to say, okay, go learn in the wild, use our city as a test case, whereas Waymo has done this very methodically, impeccable, almost impeccable safety record, and so there's trade-offs. It's going city by city, it's getting more of those regulations, but now it may not matter, right? Because other cities that are looking at what happened here in San Francisco over the weekend may say, we don't want any of that. I mean, we've known historically too, any little thing happens in San Francisco, big or small, and that has the ability to, shut down robotaxi ambitions right in their tracks. I mean, nobody was hurt. There were no accidents this past weekend, but you look at a case like Cruise, right, which happened, it was a few years ago now, actually struck a pedestrian, and that was the end of Cruise's ambitions. So that hasn't happened to Waymo. It's developing in a very different way, but regulators are already sort of on the watch for anything that goes awry, and they're held to a much higher standard.
Yeah, definitely incremental ammunition for those skeptics at the local level who might not want to experiment. Pretty fascinating, Dee, and I'm sure we're not done talking about it. Deirdre Bosa. Still ahead, it is the final few trading days of the year. What are Wall Street's predictions for the market next year? That's coming up next.
Welcome back. We are in the final trading days of the year, and the S&P 500 is about to notch its third straight year of double-digit gains. So where do Wall Street's top strategists think we're headed in 2026? Dom Chu has been tracking all that. He has it for us. Hey, Dom.
All right, so Mike, Carl, so what's going to happen here is we are expecting another double-digit type return here for the S&P 500. We've slowly been ratcheting up those expectations over the last couple of months. So according to the CNBC Market Strategist Survey, the year-end targets for at least the S&P 500 in 2026 come in with a median of just around 7,650. So call that roughly 10 to 11% higher than where we are right now for the S&P 500. Oppenheimer is at the street high with an 8,100 target price here, and Bank of America is the lowest strategist survey that we saw, coming in at 7,100. All of them expect gains, but the median target price is about 10% higher, 11% from where we are right now. If you take a look at the moves and implied price to earnings multiples, John Stoltzfus over at Oppenheimer has an implied PE target given his target at 26.5, roughly thereabouts. Savita Subramanian at B of A comes at just a hair below 23, and the median comes in just about 25. Now, the interesting part about this is if you come in at just about 25 times earnings, you are now seeing some multiple expansion from where we currently are right now. As for the earnings per share targets, Mike Wilson at Morgan Stanley comes in with a high of about $356 in estimated earnings per share on a 12-month basis. The median level's at $308 for S&P 500 earnings, and the low is Julian Emanuel over at Evercore ISI, who forecasts about $296 worth of earnings per share in the S&P 500. But overall, if you take a look at all those factors together, what it equates to is a roughly 11% gain from here. So at least there is some incremental optimism that those same double-digit returns will repeat themselves, Carl, this time around as well.
Don, pretty interesting. I was just thinking about the Savita call, who does see earnings up 14 year on year, but is worried about some multiple compression, wealth effect, I think underweight consumer discretionary, overweight staples, right?
And I think exactly it's the composition of where she thinks the gains will be, and they're not necessarily in the largest weights in the index, and therefore it mutes your upside target. That being said, if the lowest target on the street is for a 3 or 4% gain, usually there's at least one bear out there or relative bear who says, hey, you know, dead money or down next year. We're not really getting that. And I would say last year, by the way, we were similar, projecting double-digit gains, but then the April sell-off got everybody to reduce their targets, so we had a reset.
Yeah, there was some lingering bears in the course of this year. Stiefel, I think, is a good example, who kind of got burned, and then a little bit less cautious on being cautious going into 26.
That's right.
Anyway, we got a short holiday week, obviously, but still some things on the tape. Not many earnings. I think there's one earnings on the week.
Yeah, we're in that part of the year where no news might be good news for stocks. We'll see.
As we're holding, obviously, 68.75. Let's get to the judge.
All right, Carl, thanks very much. Welcome to the Halftime Report. I'm Scott Wapner. Front and center this hour, the most pressing market questions for 2026. We'll debate them with the investment committee. Joining me for the hour today, Joe Terranova, Liz Thomas, Steve Weiss, Josh Brown along in just a moment. We will check the markets here as we wind down the calendar. We are green across the board, but I said we're going to investigate the key questions for stocks in 2026. Which we've listed as such, and I think you'll agree, and we'll debate whether we've missed some of them or there are more pressing questions too. Can the AI trade get beyond the bubble banter? That's number one. Is the broadening trend durable? Right? That's what we're hearing a lot about. And can the rally run without rate cuts? Critical questions, Joe. Are those the three most pressing questions? Did we leave something out?
No, I think we have all three of them. I think the most important one is the broadening trend durable? To me, that is most important. If you think about coming into the fourth quarter, a quarter in which the S&P is 3% higher, I don't think very many people expected that healthcare would be up 11% and outperform the other 10 major S&P sectors by 8%. So I think what has happened is the personality of this market, it's becoming more discerning. It's becoming more discerning from the standpoint looking into 2026 and realizing there probably might be more rental opportunities than long-term anchoring in one particular investment theme. I think the market's going to rotate to a lot of different places, and that implies you're going to need, Scott, the 493 to participate. You cannot just rely on 7 individual stocks. You cannot rely on the AI halo to really lead the market higher. So I think that's what's going to be most critical for us. Real quick on AI, I think the market's doing a really good job in its behavior of recognizing when valuation, positioning, and sentiment gets to an extreme as it relates to that AI halo and correcting that. And I think we just witnessed that over the last 10 days.
I mean, you're almost back at 6,900. Liz, the tail of the tape, if you want to call it that, looks like this for 2025 for the majors. It's been a good year, obviously. S&P up 17%, we'll call it that. Dow good for about 13.5. NASDAQ 21.5 speaks to what has driven this market from the outset. And then the Russell 2000 has done quite well, 15%. To the upside there. Liz, what about the questions that we ask? Are those the most important for investors to consider when they think about what stocks can do in the new year?
I think they are the most important. Joe covered the broadening trend, and I would agree with a lot of what he said, so I'll take a couple of the other ones. Can the AI trade get beyond the bubble banter? I think the fact that we're all worried about the bubble banter, the bad thing rarely happens when we're all talking about it happening. So I think it can get beyond the bubble banter. The one thing that I would sort of counteract to Joe's point is that I think we do need the AI enthusiasm for 2026 to actually look good. We do need the AI enthusiasm for the broadening out trade to remain because it's so important to sentiment. And that broadening out trade, in my opinion, relies a lot on the idea that AI will start to have productivity gains in other sectors. Other places in the economy will benefit from it. And CapEx can continue not just in AI, but just generally because the economy is durable and because productivity and growth are expected to reaccelerate in 2026. So we need it for sentiment. We need it for investor sentiment and economic sentiment. But I agree that it may not be the leader in the clubhouse as far as returns go next year.
That sounds right to me. What do you think?
Well, I think, first of all, I think one of the most important questions you didn't mention, who's going to be the next Fed chair and what's going to happen at that first meeting? Because economic policy is what ultimately controls the market.
Well, it's inherent in can the rally run without rate cuts? I mean, because whoever the next chair is going to be perceived to have a cutting bias. Like, you don't have to be a rocket scientist to figure that out.
No, that's absolutely true. He's made that clear. But it's going to be, will the market, after that first Fed meeting, if there is a press conference, we don't know if they'll continue to follow that, will the market have confidence in that person? So that's going to be a critical question. We got till mid-year. Even when they name, we know who they're going to name. Market said, okay, we like all four. We're okay. Going back to your question, look, AI, it doesn't have to continue, to Liz's point, with what we saw in the first 9 months of the year, first 8 months. But it's still got to be a relevant trade to the upside, because if it's not, it's still a very large portion of the indices, and it's still very important. That will bring down the whole market.
Liz's point is like it's only a big part of the indices, it's a big part of the economy, it's a big part of the narrative, it's a big part of sentiment, it's kind of the biggest part of everything.
But there's a difference between the market and the economy, and they're not always reflecting one another. So my view is it will continue to be a big part of the economy, whether it's part of the market or not. I think it will be. I think the AI trade's going to continue. I think there are more landmines, frankly, on the private side than in the public side. But OpenAI, even though it's a private company, it's sort of is regarded as a public company. So if they have major issues, which is a possibility, then I think you'd see the AI trade collapse. But the base case, my base case is you still want to be in those stocks in the Mag 7.
So Josh, we laid the questions out as we see them. We gave you the tail of the tape on where we enter 26. UBS says equities have further room to rally, and they list the obvious reasons: the current environment of solid economic growth, healthy corporate earnings, lower interest rates, and structural innovation drivers means investors can still add exposure to equity markets. So let's get your opinion here.
Well, I think we already have the answers to both questions. And I think this year has really revealed a lot about these huge misconceptions people have about how the stock market actually works. In the first half of the year, all the bears, even like the newsletter writers, the podcasters, people who don't actually manage money, the talkers, the big thing that they told us all, they warned us, they pounded the table, if anything happens to these AI stocks, you're all dead. Remember? That was the thing. Well, none of these AI stocks look good going into year end. and the stock market looks amazing. So I think we already have the answer to that broadening question. We already know that the market has broadened out and is not reliant. And just don't take my word for it. Looking at the 20 largest companies in the XLK, that's S&P 500 Tech, use that as your proxy for the AI trade, Judge. The median percentage of those 20 largest companies below their individual 52-week highs is negative 14%. So almost all of them are verging on a correction / bear market. NVIDIA's in a 15% drawdown from its high. Microsoft 13, Broadcom 18, Oracle, we know, much worse.
Amazon 12.
So
yeah,
I think we already have that answer.
Points well taken.
Well, here's the second point. I don't care which Kevin is the Fed chair. What I care is that earnings are going to be growing next year, in large part because of the benefits of AI, and also these corporations, mid-cap, large-cap, mega-cap, have just gotten really good at finding new ways to improve profitability, and we're going to see profit margins higher next year, according to Wall Street's expectations, from 13 and change percent up to like 15 and change percent. I think the use of AI is part of that story. But look, if we can do $315 in earnings per share next year, and we're at a 21 times multiple of that, I think there's still room for the market to have another good year next year. So what matters? Does the AI trade broaden out? Well, it already has. And will earnings deliver next year? Yeah, I think they will.
Is it that simple?
Well, I think it is, and I think you have to look at just today. Look at the 52-week high list in the S&P 500. I think there's nearly 30 of them. But it's Citi, it's Freeport-McMoRan, it's C.H. Robinson, it's GM, it's Marriott. Yes, you have your Lam Research there. So it is about the broadening out, and I think that's the most important theme from an investment perspective that we carry into 2026, and the ability to kind of maintain that. As it relates to the Federal Reserve, look, I think it's built into the market already that you're going to maybe get one rate cut, maybe another rate cut thereafter. But I don't think the market's reliant in the second half of the year on further rate cuts. And in fact, if you're cutting rates in the second half of 2026, we have some sort of problem in the economy. So I think Josh is right to highlight the earnings growth, because we're coming off 4 consecutive quarters of double-digit earnings growth. And the expectation is that you're going to see that again as you move into 26. Now, is that expectation maybe a little bit too generous and a little bit too aggressive? Potentially. But seeing strong earnings growth is going to lead you into the direction of saying, okay, I have a variety of different places that I can allocate capital, and that's a healthier environment than where we were just 9 months ago, where we're just thinking about 7 stocks in an AI halo.
The average strategist target for 2026 is about 11% upside from here. The average target is 76.29. The highest is 8,100 from Oppenheimer. You got an 8,000, and you got a lowest one of 7,100, which would be disappointing, obviously. If you're going to close the year at near 69 and you think you're only going to get 200 more S&P points in 2026, Liz, that would be a disappointment for many. What do you think of the range? What do you think of the top?
I think the range is average, right? The average annual return on the S&P is right around that range. So I think it's a safe range. And I think the reason we're seeing most of the targets in that range is because we've had over 80% returns over the last 3 years. So the chances, when you look over history, after 3 years of 80+% returns, the 1 year forward return is like 5%, right? So I think people are playing it safe by saying the likelihood of us having another 15 to 25% year is really low. So we're going to just say average for next year, and it's going to come from different places. I think that's fair. I want to be a little bit more clear about the broadening out trade and what I think is really promising going into 2026. We're not broadening out into defensive areas. We're broadening out into very pro-cyclical areas. If you look just month to date, the performance and the leaders on the sector board, we've got financials, materials, industrials, right? This is all very pro-cyclical behavior, and the market is telling us that it's looking forward to 2026, and perhaps we even do better than we expect from a performance standpoint. I think the earnings growth right now now is promising, and it's something to be optimistic about. But hitting that earnings target, I think, is going to be tough. So it's possible that earnings are a little overestimated and maybe returns are underestimated.
Hey, Weiss, we didn't even talk about, the headache and the headwinds of tariff policy, right? Which, if you look at the market board like the S&P from year to date, which we have up there, you can see, obviously what happened when you had the so-called Liberation Day. So I wonder what happens to some of the tariff policy if it goes away even further into 2026, if that's when you get a upside surprise even to the more optimistic targets. If you get that headwind out of the way, because then we're not talking about, companies, they passed on this, they didn't pass on that. They ate this, they passed it to a supplier, their margins might do this or that. You eliminate a lot of questions around those issues.
And you also eliminate the question of what it's doing to inflation once you lap the Liberation Day.
Like the Supreme Court decision.
Well, that's because that's going to extend it then, if they have to pull them back, and who knows what happens there. But I think tariffs definitely become less of a problem going forward. I'm more optimistic on the market next year, and the reason is because it's typically rates that have played an outsized role in hitting markets because of an overheated economy, overheated inflation, and we've seen the market go through high interest rates and still move up. So I think that's going to support the market. So I'm positive.
Does 8,100 sound realistic to you? I know you don't forget. I know you don't like to you take shots at the targets, but it's not an exercise of target practice on doing that. But it's a sentiment idea that hey, if we can have a pretty darn good year next year. Maybe we can do that kind of number. That would be reflective of a pretty good environment for stocks.
Let me answer it this way. I think the direction's right. And to your point, I don't know if the target's right or not. And I am always bottoms up. So to me, it's what stocks can work. And I still like my positioning in the big cap tech stocks because of, again, the balance sheets, the growth, and I think you'll be out of that narrative of CapEx is too high, and I do believe you'll start seeing a return on it.
Well, look, like Wells Fargo today is standing by Oracle, for example, okay?
Yeah.
They have an overweight, they have 280, that's 45% upside. I find it hard to believe that if you can get 45% upside out of Oracle, that the AI trade's gonna look bad and tech's not gonna lead. Because if Oracle's gonna do 45%, then you're like, okay, all of this data center build is real.
Yep.
All the debt worries are overestimated, and that this trend is durable for far longer than people, the bears on this topic, would like to believe.
Yeah, and there has been no really decline in data center builds. What we've heard, some delays are occasion, and I know this factually because we're in that area, is you can't get the labor. Skilled labor is held very tight. You can't get the electricians, you can't get the plumbers, etc. So supplies are out there. So look, I still like it. Do I think that you'll get to a point where data centers can be overbuilt? For sure, but I don't think we're close to that at this point. As I look at how we're broadening the market out, I still like financials. I think this is 26 going to be a record year with a cooperative market and cooperative interest rates to get rid of all these companies that are on that private equity funds are looking to exit. That, in fact, itself may be an issue for the market. Can it absorb all this capacity? So I like financials. I continue to look at Citi. I continue to look at Morgan Stanley.
5 weeks in a row for that space, okay? Longest streak since September.
I will buy one of those too. I keep waiting for pullback, but I
one
just
of the two of which? Citi
or Morgan Stanley.
Morgan Stanley. Yeah, Citigroup. Just in the last month, Citi's up 19%. Morgan Stanley's up 13%.
Morgan Stanley's been the laggard year to date.
Yeah, Josh, how about you on that topic? I mean, like I said, you got the Oracle call. That to me says everything about if that works, then AI and NASDAQ tech's going to work. I mean, you're not going to have Oracle have some amazing year and all of a sudden these other names are not going to work. Defense today of Microsoft outperformed 625 from Dan Ives. What do you think?
Yeah, look, I think the picture that I painted earlier in this A block about how some of the big AI names were in pretty substantial drawdowns from their highs, what I didn't get to is a lot of names that maybe we don't talk about as much, but certainly we talk about, look much better, and they are also part of that AI trade. Palantir is only 7% below 52-week highs. Who would have imagined that would have been the name that would have held up, given how it's obviously the most expensive? Cisco, 3% below 52-week highs. Micron is at highs.
Oh, I'm literally
IBM,
looking right at Micron. I'm glad you mentioned Micron. Staring right at it. It's up 223%. Year to date, it's less than 2% off of its 52-week high. Not talked a lot about until the last month.
Well, that's because it didn't really perform.
So these stocks are not
last
acting like AI is unraveling. It's just people have gotten a little bit more sensitive on a stock-by-stock basis. And to me, when you hear people say, oh, it's a bubble, oh, is it really? Then why are half of the stocks involved down and the other half up? A bubble is indiscriminate buying regardless of price or even news. And we don't have that. We have Micron reacting really well to great news, and we have Oracle reacting really poorly to big concerns about the company's balance sheet. And then we have everything in between. And that's not a bubble. That's just a bull market.
Ed Yardeni says, expect the rotation into the S&P impressive 493 in 2026. Says the bull market's going to rotate away. That's because the Mag 7, he says, are facing more competition in the AI race from one another, as well as from other companies. The impressive 493 should benefit from that competition using new technology to boost their productivity and profit margins, Liz.
I agree. I mean, at the top of the show, that's what I said. That's sort of the broadening out depends on the idea that this will start to reach into other sectors of the economy, other sectors of the market, and that as competition heats up, it actually gets better for the other sectors that are going to use AI for productivity. It gets better for consumers that are going to use AI. The reality is we're still very early in this life cycle, and we have no idea how this is going to shape up for the next 5 to 10 years. I mean, the internet was sort of the same way. And the other thing about, if you're looking at what's happening in the economy and the Fed and all the transitions that are likely to happen in monetary policy in 2026, we've got, very simply put, a first half of the year that's characterized by stimulus and bond buying again. And then whenever this new chair gets into the seat, we've got a second half of the year that if it does reaccelerate, maybe they don't have to cut rates. Maybe they even start talking about pausing and having to hike at some point. Back in the 90s, that happened. They had to hike. They had to start hiking again because the economy heated up. The market did just fine. So all of this fear that everybody has about if we don't get the rate cuts we need, it's not going to work, I think is completely overblown.
I disagree with that. I disagree with Ed Yardeni's premise. I don't see competition heating up and that being the death knell for the performance. I actually see a market that's expanding at a pace that we've never seen with any other technology before, that's creating more opportunities for these companies. Now, aside from Meta and Google, Alphabet competing for ad dollars, I think the ad markets continue to grow for them. I don't see the competition with
but
the
the dispersion among the group has already been taking place. He just suggests that it's going to continue to be that. If you look at the performance of the Mag 7, what was at one point all things looking kind of equal, not so much.
Well,
not so much.
And we've seen that periodically. I mean, at certain points, Microsoft's outperformed one, or all of them. I just don't think that that's the case. I think the stock market looks great for all of them, and the true economy market looks phenomenal for them. So I wouldn't make that determination.
I don't think the Oracle story is going away. That doesn't mean the stock can't rally in 2026. You're talking about, as it relates to Oracle, the need to continue to fund, whether it's for lease obligations or the spending, their free cash flow is going to go negative. That story is not going away in 2026. So you're going to have this environment, as I said, I used the word before, discerning, and I think that's the environment when you're looking at the Mag 7 names.
But what about what
Yardeni
says?
Names.
What about what
That's
Yardeni
already
says
happening,
about
though. The broadening out is underway. The question is it going to expand now into the energy sector? Is it going to go to some of the sectors that haven't performed this quarter? That's here. That's present.
Yeah, but maybe it can, like, for example, if you look at, since we were talking about financials, what about insurance? Roth Capital today says those are ready to break out, right? After they looked
Making
pretty
a
good,
return.
they looked bad, and now they seem to be picking up again. You got a lot of exposure here.
Yeah, I do, and their assessment there is a little bit incorrect. Because what it is making a return. Remember, it was the insurance companies that led the financial sector in the early part of 24. And then as we moved into 25, they kind of lost their pricing power and underperformed the rest of the financial sector. They're coming back once again. Why? Because in most recent earnings, you're seeing that the pricing power came back once again. So I think it's a place that you could be in 26. They're reestablishing momentum. And I think the best thing that happened for these insurance companies is they worked off some of that overbought positioning and extreme bullish sentiment, because in the financial sector in early 24, they were really the story. You didn't have the money center banks, the regional banks participating at that point. Now you do. You have the dispersion in the financial sector.
Josh was talking about, you spotlighted regionals in terms of your best stocks column within the last week or so. Huntington Bank shares on the list.
Yeah.
Joe owns that. There seems to be, the regional bank ETF hit a 52-week high last week, so there seems to be momentum behind that.
Yeah, the consumer is okay. Of course, not every single consumer in the country, so nobody write an email. Generally speaking, the consumer is spending. Small and mid-sized businesses are navigating higher costs, and things are moving along. And we're maybe going to get a housing cycle. I can't say that definitively, but the 10-year cools off, and you get a little bit more relief in mortgages than we've already gotten. You're going to see an upcycle in housing. And so business lending, small business, mid-sized business, housing, and the consumer is what matters for these stocks in addition to their net interest margin. And you've got this confluence of events where you're starting to get green shoots across a lot of those things. 17% of names in the KRE, Regional Banking Index ETF, are at 52-week highs today. That number averages over all months about 4%. So this is like a triple to quadruple better than normal situation for those names. And nobody owns them, like literally nobody.
Now, this is interesting. We'll take a quick break. And when we come back, we're going to tell you about one area of tech. January is the best month for it. We'll reveal it. We'll trade it. We do have ownership. We'll discuss next. Welcome back. BTIG's Jonathan Krinsky today says China Tech is poised for a January rally. That January is the best month of the year for the CQQQs, averaging a 4.22% gain. Attractive entry point now for that trade. Weiss, you bought more BABA on Friday. So maybe that was good timing to do just that.
Yeah, and I didn't have that in mind when I did. What I had in mind was...
Well, presumably you didn't know that.
I did.
As much as you know.
As much as
you
I
didn't know that.
No, I don't focus on the minutiae. I focus on what's important.
Yeah.
Look, I think the stock is very inexpensive. They are the leader in cloud and will be and are in AI. So I think the same trends that we've seen with stocks in this market will continue in that market. Now the stock's almost doubled, over the last year. So it's not undiscovered, but I still think there's an appetite, including me, of skeptics to get involved in the China trade.
He does mention BABA specifically in charts that in his mind look constructive, along with Baidu and Tencent and JOYY.
Yeah, I just think BABA is the horse in this race, and that you want to be involved with them.
You have a thought here?
I certainly do. China so far year to date has had a very strong return. If you look at the ETF, the MCHI, it is most recently that we've seen the pullback since October 1st. Why is that, Scott? I know you're a huge fan of the momentum factor.
I am.
If you look at when the momentum
and quality
factor,
too.
When the momentum factor outperforms, okay, there's a strong correlation with other factors, equity styles, high beta names, and in fact, if you go back and study over the last 5 years, when momentum outperforms, China outperforms along with it. So ownership of a lot of the names we're talking about with China, the environment that they need is a strong momentum factor and a strong high beta factor for those names to work. Since October 1st, China's down 8%, momentum factor is down 1%. If you're telling me in January China's going to have outperformance, that means the momentum factor comes back once again.
Josh, you've been in this trade. I mean, BABA's getting a lift. What do you think about this Krinsky note for something you've been in? I mean, you've done it through the K-Web in the past.
Yeah, on my radar. I haven't pulled the trigger yet. These stocks don't need me. They seem to be doing really well. But I do find it an interesting setup going into next year. I'm going to have to sharpen my pencil.
China was one of my contrarian calls in 2025. I've owned K-Web for a long time, actually added to K-Web on Friday. So I'm with Krinsky on this one. I do think China has a good fighting chance. I mean, they're in this race and they are fighting to win. I don't know that they will win the AI race, but they're in it. And I think that it's something to, certainly right now, a good opportunity to get in if you haven't been in it.
The good news is they don't have to win it, because it's a closed market. BABA just has to win it for themselves, and just have to see the expansion of the market, which we are seeing there, to have the same effect that we've seen here.
But it just feels like 2024 was like uninvestable, the idea on the desk.
Yep.
Right? 25, obviously, if you look at the gains, the CQs are up 31.5, K-Web up 19, but BABA's up 77% year to date. Baidu's 46. Other names are almost similar in terms of what the idea about this trade is. Now, who knows, with 26 can go back and be like, you know what, there's some regulatory thing that happened, now I don't trust it again, and then you see the volatility come back. But there seems to be enough optimism heading into the new year around these names, and then maybe the technicals are lining up with that too.
Yeah, in 24 it was India that you wanted to own over China. I did. And you did, and in 25 India has dramatically outperformed China. So look, I think
I owned India coming into
that negative correlation is in place in 26. If it's going to be a strong year for China, then I don't think India performs well. And the alternative is, if China does struggle, I think you'd want to own India.
All right, well, there's the BABA bounce, just about 1%. We'll watch that. Let's get the headlines now with Christina Partsinevelos. Stay there.
Hi, Scott. Well, Senate Minority Leader Chuck Schumer introduced a resolution today directing the Senate to begin legal action against the Justice Department, alleging it failed to meet a deadline to release documents related to Jeffrey Epstein. The Democratic New York senator will force the Senate to consider the measure when it reconvenes in January. The Deputy Attorney General, Todd Blanche, defended the partial release of the file, saying it was just necessary to protect victims. Russian officials say a military general died in a car bombing today in Moscow. It marks the third killing of a senior military officer in Russia in just over a year. Investigators are suggesting Ukraine may be behind the attack. Kyiv has not commented. And singer Barry Manilow shared today he has been diagnosed with lung cancer. The 82-year-old said in an Instagram post that his doctor found a cancerous spot in his lung in an MRI. He says he will undergo surgery to have the spot removed and will have to reschedule his January shows on his current tour as a result. Speedy recovery. Scott.
Christina, thank you. Christina Partsinevelos. Coming up, Josh Brown, his best stocks in the market. He says this struggling stock finally has found a bottom, and it's a buy right now. We tell you which one next. All right, we're back. Longest streak for the transports since July. 4 straight weeks of gains, which is why the spotlight for Josh Brown's best stocks in the market is shining bright on that group today. And a couple of names. Which ones?
What a setup. CSX and FedEx. I'll do CSX is a little bit more cut and dry. I'll do that one first very quickly. The stock is an unqualified buy right now. It broke out. It had a low volume retest. These are all the things the technicians tell you are important. I think the stop here for traders is 35.5. You can see that has been support historically, so relatively small downside. If you're an investor, obviously I'd give it a little bit more room. It's not a very volatile stock, but it is challenging. Very key level here, 36.37. It's had multiple opportunities to try to get above. Has not happened yet, but once it does, I think this name rolls right into the low 40s. FedEx is a little bit more of an interesting story. This is a company going through a turnaround, reported earnings last week. The earnings were good, and they got a bunch of price target bumps from Wall Street, and you can see that the stock had been rallying going into those numbers, so nobody was shocked, but next year will be a better year on revenue, on pricing power, on margins, on earnings per share than this year was. And I think 300 to 315, give me like a little bit, give me like a 5-year chart. What you can see is that this has been an area of resistance that is now being challenged again. I don't believe in triple tops. So you see late 2020 into 21, 300 was resistance, rejected. Then again, it happened in 2024. Here we are going into 2026, third time's a charm. I think the stock will break out because it's not just technicals. It's a fundamental turnaround here. And I still believe that there's opportunity. I would anticipate the breakout, and I would start getting long right now.
Okay, let's see what we think on the desk. What do you think?
I like it. I think there's a global logistics story that really is very quietly underneath the market in a very strong bull market. We have ownership of Expeditors International. That gets you 70% revenue exposure outside of the U.S. I like the names that Josh is mentioning here, FedEx and the rails. I think you could even turn to a name like Prologis, ticker symbol PLD. That's giving you the participation in what is right now a bull market for global logistics.
All right, good stuff. Up next, we have a fresh committee move. Joe is ringing the register on a stock. It's up 28% this year. I'll tell you which one next. All right, welcome back. Got a move from Joe T, which is what? What'd you do?
CBOE. you would say we rang the register on it. I rang the register on it because I own it personally.
Okay.
It really boils down to relative underperformance, and something that I look at and I utilize in my investing and trading strategy, and that's where is an individual equity name versus its industry or versus a sector. Relative since the last 6 weeks, going back, CBOE has unfortunately underperformed even with really good earnings. It's underperformed some of the various exchanges, and certainly it's underperformed the financial sector. So at that point, for me, it's a motivation to move to the sidelines, ring the register. I still think it's going to be a really good environment.
You made money in it?
2026
You made money in it?
I did.
Because when you say you ring the register, I mean...
Yes, I did make money on it. Let me get my last point out, though, as it relates to options. I still think 2026, we look at where the VIX is right now, near a low for the year, below 15. I don't think even if it's a positive year next year in 26, you want to be short volatility. I think volatility is going to increase substantially in 26, even in a bull market.
Okay, so you still own the CME Group, and you still own NASDAQ, which Josh, if you remember, highlighted last week during his best stocks in the market list.
Yes.
In the context of discussing the idea of the 23-hour trading, which they are pursuing.
And I
you like the exchanges in general? Why hasn't this one worked relative to some of the others? Why hasn't CBOE?
CBOE.
Yeah.
CBOE,
Yeah.
I think since earnings, maybe positioning was a little bit full, maybe it was sentiment. I don't think you could identify one specific reason why, in fact, the stock has been experiencing the relative underperformance. There has been very strong enthusiasm around the usage of options in the capital markets. I think that led to a lot of people owning CBOE. And I think CBOE is going to be fine in 26. I think from where it is right here, I'll look back, I'll say it was a poor sale, but it's really understanding what I use as an indicator, and I don't like relative underperformance versus an industry or a sector.
You might say this is a good sale because, Morgan Stanley has reiterated they're underweight on CBOE. Josh, they reiterate they're overweight on NASDAQ. They take the target to 111. CME Group reiterated overweight. The target goes to 320. Schwab, they put in that group, reiterated overweight, and the target to 148.
Yeah, it's a strange grouping. Schwab doesn't really belong with the other three. The other three are exchanges, and directionally not as important what happens with, for example, rates or stocks. I mean, obviously, in an upward direction is more helpful for certain types of business, like NASDAQ, but volatility is better for, CBOE. So, the driver is just increased activity, I guess would be the point. Whereas Schwab, a lot of the money being made there is coming from sweeps on cash balances, et cetera. So maybe the rates picture is more important for them. But I still think they do well with a rising tide, asset management businesses, et cetera. I like Schwab. I really like NASDAQ. I think it's just a crown jewel amongst this group. They're benefiting from IPOs. They're benefiting from more data, listing activity, trading, just so many different ways to win.
Okay, let's take a break. Santoli, he's on the other side. He'll join us with his midday word next. back. Senior markets commentator Michael Santoli is at the desk, and you, like us here on the desk, are asking the key questions, which you think are going to be front and center. I love the way you frame one of your questions. When you talk about the broadening, right? Yeah. We ask, will the broadening trend become durable? Yes. You say, should investors truly wish for a broadening trend away from the tech leaders? Why do you frame it that way?
Part of it has to do with how we're going to define it. I mean, if we define a broadening as if, the AI-led cohort of stocks, let's call it 8 because you need Broadcom in there. If they're going to somehow cede leadership and do you actually want that and expect the bull market to continue on in a seamless fashion? It would be against history to say that you're absolutely going to have a wholesale shift of leadership. Now, there has been more strength elsewhere in the market, right? Banks are leading. I would say selective and eclectic is what you want, and kind of a rebalanced market in that sense, as opposed to what worked in the last 2 years. Let's hope that doesn't work. And a market that is in the hands of the Russell 2000 and chain retailers and the railroads and all the other stuff that people feel like it's been neglected is a more treacherous market, and it does not have the same kind of valuation upside. It's not anchored by the real capital flows that have been driving this bull market.
Josh, what do you make of that? It sounds like something that we really need to think about.
Yeah, look, I think on a day-to-day basis, the narrative changes so much. And we do have these days where it's an anything but large cap tech, and then days where, oh, look, it's the same old stocks going up again. How come I don't own more of them? I just think that rotation is super healthy. I think Michael probably agrees. Like, we want for there to be that passing of the torch back and forth. It's a good thing, not a bad thing.
The other thing, Mike, that you ask is the link between crypto and tech broken in a lasting way, and if so, why? Explain.
It's very interesting. I mean, first of all, asking the question if it has broken in a lasting way. I mean, you've seen the NASDAQ 100, it's almost back up to its highs. Bitcoin's trying to base here, it looks like, around 90K, but it's not really getting a lot of momentum. And I really just wonder if the same kind of attitudes and flows that chase the next big, hot, exciting technological thing, is not really going to find itself in Bitcoin the way it did before. And I just put myself in the mind of the 22-year-old Robinhood client who says, this thing's been around 15 years. It's what it's going to be. It's not necessarily as exciting as the space stocks or whatever AI is going to create, or robo-taxis and
prediction markets.
Yeah, right. All of it. And so I just asking the question as to whether it's no longer going to be the same kind of risk appetite proxy that it's been in the past.
Well, it's a good question. We'll have to wait for the answer, obviously, but it's good stuff. Thanks. We'll see you at 3 on Closing Bell when Mike is back with me. Up next, the commodity playbook from the committee. Gold and silver prices are soaring to new highs today, plus Joe with yet another move in that space. I'll tell you more next. let's talk commodities for a minute. We have gold and silver, new record highs today. Oil, not so much. Worst sector for energy. Worst sector last week was energy, excuse me. That's where your move is, right?
Yes.
Apache, you sold it.
I did.
Tell me
Terrible
more.
trade. Terrible trade. Natural gas is up around $5. I already own EQT. That has been a strong winning position for me. I added Apache as natural gas approached $5, believing natural gas was going to break out above $5. It absolutely has not done that.
How long have you owned it?
Back over. Apache's a couple of weeks at most. It's a terrible trade. Down maybe 8% on the trade.
Oh, you are?
Yeah. Got right out of it.
Okay.
Moved to the sidelines, natural gas right back below $4.
Okay. I mean, because I have it up 3% in a month, 4.5 in 3 months. I mean, so really, you're talking about a very small
I
period
probably
of time
bought
that just didn't work.
I probably bought the high of the entire move. I know
Well,
that
that's how you
natural
roll, right?
Don't you want to buy high and sell higher?
and sell higher,
You do,
right? I
Yeah.
mean,
sometimes
the
that doesn't work out.
himself in his book.
Yeah, and sometimes that absolutely doesn't
He
work
talks
out.
his own book.
Yeah.
Natural gas was $5 at the time. I'll tell you a trade that is working that I bought at the high.
Okay.
GLD. Bought that 1 month ago, up about 10% on GLD, and I think that continues to move higher because gold's going higher.
Still optimistic about that for 26?
I am. I'm optimistic about gold. I'm optimistic about silver. I like that Liz is nodding that she agrees with me. Yeah, I am.
I agree with you on gold. I agree with you on gold.
On gold?
I was optimistic about gold in 25, still optimistic in 26. Silver is a speculative commodity more than gold is. I think there's more of a floor on the gold demand. I don't think that you see as much of a possibility of a drawdown, but silver's up a little high for me, a little fast.
Okay.
So there.
A little high beta, silver.
All right.
Yeah.
We'll do finals next. All right, 3 o'clock Eastern closing bell. Tom Lee, will be with us. Jeff DeGraff, Richard Fisher, Stephanie Link, Malcolm Etheridge, Chris Harvey. We'll kick around the key questions facing you in the new year and this market. Josh Brown, your final trade is what?
Toast, snapping a declining 50-day moving average headed higher.
All right. White shirt toast. What do you got?
In a similar move.
Keep it up, your toast.
Uber. I mean, I think Uber, it's bouncing today. I think it'll continue to bounce for a little bit.
Okay. It's a nice looking bounce. Liz?
Materials expected to be the second best sector in earnings in 26. Cyclical bounce, hopefully incoming.
Joe T.
No better reflection of the broadening out trade than the XBI and the performance it has had over the last 3 months.
Well, you said that was your favorite trade in the market right now.
It's been the best trade for me so far personally in 2025,
Okay.
and there's very limited time left in the year. So I think it continues to move higher above 125. I think it's talking 145, 150 at some point in early 26.
All right, speaking of limited time, we're out. See you at 3. Exchanges now.
Thank you very much, Scott. The AI trade is very much back on. Paramount is back in the race, and Elon Musk isn't telling the whole story. Welcome to The Exchange. I'm Kelly Evans, and stocks are higher to start the shortened trading week with the Russell 2000s leading the way today, now up 1.6%. Dow's up about 306. And there's buying back in some of the AI names that's helping the NASDAQ today. NVIDIA, Oracle, Micron all seeing some nice gains. Plus, metals momentum is still strong, with gold and silver, as you just heard, hitting new highs. And while Bitcoin briefly rallied back above 90K, we are back below that level right now. We begin today with this comeback in the AI trade. The NASDAQ 100 turning positive on the month now as investors reassess names like NVIDIA, Oracle, and CoreWeave, all three seeing big gains over the past week. NVIDIA shares up 4% as the company lays out plans to ship those chips to China. Oracle continues to move higher after its JV with TikTok, and CoreWeave is up nearly 20% in the past week. They joined the Department of Energy's Genesis mission. So is the AI trade back for good this time, or will this rally fade again? Let's ask Gene Munster. He's managing partner at Deepwater Asset Management. And Gene, I'm curious what you think. I have a theory, but I want to know what you think is going on here. I mean, to me, it seems like a lot actually improved sentiment after OpenAI did that massive raise last week, after Sam Altman came out and defended kind of the idea of where's all the money going to come for their data center ambitions over the next few years on that podcast that Alex Kantrowitz. Is that what turned things around here? What do you think is going on?
I think that was the moment. And just to put some more context on that, this $830 billion valuation, the fact that they're confident that they can raise tens of billions, I think is evidence of an example of a private market company that's really setting the narrative on the public side. And I think that this whole concept that this is a profitless prosperity around these large language models, I think is continued to be put to rest. We understand, and investors understand, that the pricing of tokens is going to go down by Sam Altman's account 10x per year. But ultimately the usage is going to increase by more. And I think that is at the center of this big raise. I want to put some more quick context about why that was encouraging. If you look at his expectations about where their revenue is going to go over the next few years, doubling in each of the next few years, that basically puts OpenAI at a valuation of about 12 times calendar 26 revenue. Now, that is very favorable relative. That's kind of in line, maybe like a slight premium to the rest of software, for example. And keep in mind that this is growing at 100% versus software growing at 15%. So
let
Kelly,
me just jump in there and say, in other words, what you're saying is they're trading at about 12 times price to sales. I know it's not a perfect metric by the end of 2026. Which is in line with where other software type companies would trade. They're not trading, in other words, at some crazy multiple if their revenues are achievable in just the next 12 months.
Exactly. And I just want to emphasize one comment, which is where the whole AI conversation comes down, if that is achievable. And ultimately, I'm in the camp that this is achievable. I think that there's upside to that 100% growth. They've showed that they've continued to do that. And I think that this commentary about this raise gives some investors some confidence to look back over the past month. There's been 5 positive data points, large positive data points related to the OpenAI, everything from Micron earnings to commentary from AWS's CEO about how they're building out. NVIDIA raised their guidance for calendar 26 from 50% growth to mid-60s. and that excludes age 20s. And so I think what this has given us, this gift essentially from OpenAI, from their fundraise, is giving investors a chance to step back and saying, wait a minute, maybe I looked past what has been some really impressive updates related to where AI is over the past month. And so I think that's part of the recovery. And I emphasize the word recovery. It still isn't fully, I don't think the market is fully factoring in all of the good news we've heard around AI over the past month.
Sure, and I'm going through your list here, and you're like, look, I mean, you've mentioned some of this. Amazon Web Services, demand keeps skyrocketing. NVIDIA raised their calendar 26 growth to 65% from 50 just at the end of November. Broadcom, I mean, let's talk about what a quarter that was and look at what happened with the stock. Oracle, right? Can I ask a weird question, Gene? It seems like, in a way, the better OpenAI's prospects look, the better the whole AI trade does. Whereas the better Gemini's prospects look, which seem to come at the expense of OpenAI to some degree, the more that trade looks a little shaky, even though it's good for Google's shares. Am I overemphasizing that distinction?
I think so. I think at the end of the day, the central question we're all asking, back to a comment you had a minute ago about if they hit this, I think when it comes to Google, when it comes to OpenAI, all the large language models, all these companies, is just that simple question of do you believe that ultimately the growth of these companies will exceed high expectations? And I think if Google continues to grow search higher than where investors think, it's kind of 11, 12% for calendar 27. They recently grew at 14%. Look at what's happened, obviously, with Google Cloud and that impressive growth. If they continue to do that, I think it's going to be a positive read for the overall AI trade. I think that whether it's Google or positive commentary comes out. Now, that's the good news, is that across the board, the data points continue to be most positive. Now, again, the market may not give it credit in any week to week, but the data points have been most positive.
Yeah.
The challenge there is that imagine what would happen if we actually got a negative data point. I don't foresee one, but I think that is the question that continues to nag investors. Are we 1 week away from a negative data point, which ends up kind of putting us in a funk again?
Right now, I mean, even look at the stock reaction for Broadcom and Oracle, and yet, what did Broadcom say? Their AI revenue was up 65% year on year. Their backlog went up by $50 billion to 160. Half of that is in AI. That backlog went up to 73 billion. I mean, the numbers in that sense just keep getting better. I guess to your point, the only question remains, well, how much longer can that literally remain true?
Well, let's look at Micron. So they reported on December 17th. They guided their next quarter to $18.7 billion in revenue. The street was at $14.5 billion. Stock's been up 20% since then. But like that is an example of these high bars continue to get crushed. I want to rewind on NVIDIA, for example. We've talked about that 65% growth is what they're suggesting. The street's not there yet, but that's what they're suggesting. If we go back and look at where we were a year ago, the expectation was for 18% growth in calendar 26.
Wow.
And so when the point is this, is it keeps coming back to, it's hard for me to imagine. I want to be level-headed against all the noise that's out there and don't want to take the bait of just looking at this with only rose-colored glasses. I don't want to take that bait. But the reality is that the amount of investment that's going on, I think, is going to be more substantial than what the bullish cases are. And ultimately, that's the brain of AI. It's getting bigger and bigger, and eventually we're going to see the output, the use case, the utility kicking in, and that's the reason why I believe we're still early.
Yeah, and Sam talked about this, telling Alex Kantrowitz, like, look, he's like, I'm seeing what these models are going to do. They're going to keep getting better and better. And I know there's some skeptics who say, well, at some point, they're going to get so efficient they need less compute and all of that. But it's amazing what you said, which is that a year ago, NVIDIA's projected growth rate for this coming year was 18%, and now the company itself is telling you it's going to be 65.
Right, which means it's probably 75 or better.
Crazy. So do you think it becomes more efficient over time, and ultimately all of this compute, is obsolete? And if so, does it matter because we're still multiple years off from that, or could that be the kind of thing that comes out in Q1 and takes the market? I mean, and it's interesting that the biggest thing investors are puking about, if you'll pardon the language, with Oracle, for example, is that their investment, they think, is going to be up 67% versus expectations next year. I mean, that's a huge number, right? So the pushback seems to be, hey, you're going a little too crazy. But I guess if you were, from the Bulls' point of view, it's look, this is a new era of compute, and at least they're going all in.
Yeah, we'll go back to that question about, like, do you believe, like, what level do you believe? Even the people who are skeptical about this will say that AI is going to be transformative. It's the level of transformation. But this idea about, like, compute getting cheaper and therefore profitless prosperity, I mean, that's a well thought out negative case on this. But again, my belief, I think we're actually going to see a surprise where the pricing of this 10x decline that Sam Altman's talking about, I think when these models start actually showing the utility that they're capable of, I don't think we're going to see that kind of pricing. Quick kind of context to this is over the past 20 years, we've gone back and looked at 10 different content services like Apple Music, Netflix, Hulu, Sirius, for example. And that was always like this profitless prosperity around content. And it turns out that the pricing on all those services on average is growing 3% faster than inflation. And so the reality is this: when something becomes indisposable, people will pay up for it. And I think that is going to be the surprise moment in AI. We're probably a couple years away from it, where all of a sudden the profitability of these LLM companies, like everything from xAI, OpenAI, Anthropic, I think the profitability of these is really going to surprise to the upside.
Yeah, and I know, as you say, we're not even in the go-go years yet. We haven't had the gold standard AI companies going public, so we haven't even had the second tier. So I guess you can rest a little easy. Gene, thanks so much. We appreciate it today.
Thank you.
Gene Munster. In other big news, Netflix may not win Warner Brothers after all. At least that's what Paramount is hoping. After they beefed up their bid for Warner Brothers Discovery, they didn't boost the offer per se, but Larry Ellison is now personally backing the bid, guaranteeing $40 billion in equity financing for the deal. The elder Ellison stepping in to address WBD's concerns over where the cash would come from. Shares of Paramount and Warner both higher on the news, while Netflix is down about 1%. Here with his thoughts is Peter Supino, senior analyst at Wolfe Research. And Peter, do you think this increases the odds that Paramount actually wins?
It definitely increases the odds. These horses look like they're neck and neck. Paramount, with today's news, has given the Warner board more of the certainty that it's been asking for, although we're not convinced that it's offered enough to get this done.
Remind me again what your thoughts are about kind of who this makes most sense with. Is it Paramount or is it Netflix?
Well, the company that can make the most of Warner Brothers economically is Netflix. Netflix has the best mousetrap in the world for turning long-form premium video into profit dollars. However, this merger might be much more important strategically to Paramount. Because scale is just so important in streaming, and Paramount doesn't have it, at least to a competitive degree right now, and Warner would really vault Paramount forward.
Right, and look at the share price of Warner Brothers. It's trading up 3.5%, closer to 29. I believe Netflix offer was it 28, and Paramount was 30, is that right?
Yeah, so Netflix offered $27.75, and it's important to remember that the Netflix offer leaves a stub equity as an additional source of value for the Warner Brothers shareholders. And so what I mean is the cable network portfolio of Warner Brothers, which will be known as Discovery Global, will continue to trade. It'll act like a dividend to the Warner Brothers shareholders. And so we think that's worth about $1 per share, per WBD share. And so the Netflix offer should be thought about as $27.75 for the studios, plus $1 for that streaming and studios, or for that Warner cable network portfolio. That adds up to just under 29. It's funny that the Paramount merger or offer looks greater at $30 cash, but if Warner goes with Paramount, they have to pay a breakup fee to Netflix of about $1 per Warner share. And so both bids right now, from a value perspective, end up near 29.
Fascinating, and there we are, 24 cents shy of that. So again, the market is kind of recognizing all of this. So if you were the chair of the board now,
market is saying there's a higher bid coming for sure.
Exactly. So who's going to raise their bids? Are both sides going to raise their bids? If you were the chairman of the board, or the board itself of Paramount, what do you do here?
Well, Paramount seems to have made 6 offers by their own statement, and now they've adjusted this offer. And so I have a hard time convincing myself that this is their last and final. Netflix has plenty of capacity to pay more. Their equity market cap of $425 some odd billion makes this a relatively easy financial bite. And so I can see why the arbitrage market is betting on a higher deal price.
And if Netflix were to just say, ha, just kidding, we just wanted to inflict the most pain on Paramount, raise the price as much as possible, we walk away with our breakup fee and we're chuckling all the way to the bank, is that actually a good outcome for them, or would the much better outcome for Netflix be to get access to this library and these assets?
Netflix is in such an enviable position because they have a bright future on both paths. Having said that, I think they'd be better off buying these assets. The stock market has sold off Netflix stock because of the uncertainty that this deal brings into the Netflix story. Netflix has been this beautiful, pure play organic growth company, and that would come to an end with this merger. But we think Netflix would be a terrific owner of these assets if they can win them. Paramount just needs them more, and so our probability, we've been assigning a higher probability to Paramount winning for that simple reason.
All right, we'll see if they make a move to raise the bid. Again, Netflix shares are down 23% over the past month as this rages on, and it's not over yet. Peter, thanks.
Thank you.
Peter Supino with Wolfe Research. Coming up, we're down to the final 4 candidates for Fed chair with one more interview to go, what the prediction markets are betting, and what the winner will mean for rates. Plus, gold and silver prices are back at record highs, but can the momentum continue into next year? We'll delve into that and the stocks that may benefit on Tim Seymour's naughty and nice list. The Exchange is back after this.
This is The Exchange on CNBC.
We are theoretically in the home stretch of the race to become the next Fed chair. The president's set to interview BlackRock's Rick Rieder at Mar-a-Lago next week, making him the final candidate to meet with the president in this final round. I feel like I'm talking about the NCAA or something. Kalshi prediction markets have NEC director Kevin Hassett in the lead with a 57% chance of getting the job now. There's Warsh at 23, Waller at 12. I don't see Rieder on that list. Steve Leisman, who is here with a closer look at some of the wild card factors.
That's a production thing. He's about 6% is my understanding.
6%, okay.
We'll get to that. But the extended search for the next Fed chair, Kelly, reaching the end game, to use the sports metaphor, with 4 remaining candidates. People familiar with the situation say the president could name the new Fed chair by the first week of January after reviewing the last candidate, Rick Rieder, at an interview in Mar-a-Lago. There's been pushback on Wall Street against NEC director Kevin Hassett, as reported by CNBC. You can see there Politico had a story, and the FT as well. Concern Hassett is not seen as independent enough from the president. But the Treasury Secretary, he's pushed back on that criticism. He's also supported reforms at the Fed similar to those called for by former Fed Governor Kevin Warsh. The process of interviews, first at Treasury, then at the White House, and winnowing it down to now 4 candidates, was one Bessent championed beginning back in the fall. So he's like in favor of all of them, leaving unclear which of the 4 remaining candidates Bessent supports. But his comments on Hassett did help restore him to be the runaway favorite at 57% in those prediction markets. You could see there with Reader not there at 6%. Bessent might want to steer clear of favoring one candidate explicitly because his predecessor is continually blamed by the president for the pick of Fed Chair Powell, who the president doesn't like. Bessent also knows that in the end, President Trump is going to make this choice on his own. It's not a committee decision.
I was just thinking about that, how he's a Steve Mnuchin, he gave me a bad pick with Powell, but what is it, right now we all think we kind of know about these candidates, and then they take the job, and you realize that even the president may not have really known what he wanted to know about them and maybe about how they do the job. Is Rick Reeder a Democrat, by the way?
It's my understanding he is, but I will tell you, Rick Reeder won't talk to us. He's like the most religious guy about not talking at all. He's old school in that regard.
I don't know if that's more or less endearing to the president, who sometimes seems to like this kind of winky relationship between the press.
Having covered several of these, this is the most different of any one that I've ever covered, and I say
in what way?
Well, it's all public. Right. I mean, it used to be that I can tell you, if you were a Fed governor or a Fed president, if you were nominated to be a Fed governor, Fed president, you shut up right at that moment. And only several months after approval would you ever even deign to talk to the press. Now it seems like talking to the press is part of the process.
I agree with you. It does seem, that's what I was joking about, this feeling like the NCAA. We shouldn't really, it feels odd to be talking about it. I almost don't trust that we know as much as we think we know about the process, if that makes sense.
I think that's probably true. I think the people who I talk to who think they know about the process admit they don't really know about the process. That's part of what's happening here. But I do think it's interesting to try to focus on what Bessent may want. And it's very hard to figure that out right now because he's sort of been, to me, he's been a bit like sort of the rudder that's keeping the ship on tack in terms of where it's going with the interview process and keeping that process but both transparent. So you don't want to be critical of the administration in the sense that they're being more transparent about this than other administrations as well.
Right. It's like they might be more political, but they're also more transparent about being more political. They would say they're not being political, I'm just saying.
Right. And it's opened the door for a lot of this politicking that's been out there. That's one of the reasons why you had, I mean, those 3 stories we put up, mine was one that was sort of talking about Wall Street people being concerned. The Politico story had the pushback on Hassett coming from inside the White House, which we did not have. And I think there's talk about some of this being an orchestrated campaign. And I think what we've picked up was something of an organic campaign. But then, Bessent pushed back on that, and that restored Hassett's odds.
Quickly, if you had to say what would be a real wild card right now, is there anything else that kind of may lurk here and surprise us in this process, or do you think this is kind of what we know?
I don't think so. I think there's one wild card thought here, which is interesting to me, which is the president could pick the person most likely to do his bidding. But he might also want to pick the person most likely to be able to sway the committee. In that sense, somebody like Chris Waller goes up in value to the president. Like, you can have a guy who and it's going to be a guy.
If it's someone too political, where the rest of the committee feels like would to push back against
him, then the president would not get the lower rates he wants, as opposed to somebody like Chris Waller, who I think many people acknowledge has done the best job of laying out the case, not just that he wants lower rates, but a system or a framework for why rates can be lower.
Right.
And that's something that I think Powell has adopted and other people as well. And that's come from the labor market by saying, you know what? The labor market is not going to be a source of inflation. And so therefore you can cut rates and not worry about the tariff-induced price increases.
I love it. Steve, thank you.
Pleasure.
Really appreciate walking through us as always. And let's turn to our next guest, who says whoever leads the Fed next inherits a numb economy. His words. What does he mean by that? Let's bring in David Hardin. He's CEO and Chief Investment Officer at Summit Global Investments. A numb economy. What does that mean?
Well, that's a great question, Kelly. Thanks for having me. I think if you look at this last year, we've had a number of shocks, from the federal debt to shutdowns in the government, strikes, geopolitical risks, and they're going to continue in 2026, but we're kind of numb to it. No one's really doing anything. The consumer is still spending.
So it's a good thing.
Unemployment's still low, and that's a good thing. And so I think overall, no matter what he chooses for this Fed, the reality is I think the market marches on.
In other words, we can't be too shocked by whatever's coming. The economy is kind of in a good spot. The consumer is going to get a tailwind next year. And, you know, this politicking at the top of the Fed, I mean, probably the bigger risk, honestly, that a lot of people are worried about is maybe slightly looser on the margin, and the economy doesn't need policy that's that much looser. That's probably the bigger risk for the markets.
Right, and it gets kind of like old news in the sense of we hear it so much, we just are tired of it, so we just move to other things. Yeah. And so we look for other things to keep our attention.
That being the case, David, how are you setting up for next year? Talk about being numb. You know, is it AI? Is it not the AI trade? What do you think about the metals? I mean, there's a lot of topics that are becoming, you know, sort of, we talk about them almost constantly, but you have to still decide which of these are going to be the best stewards of capital for the next 12 months.
Well, and if you look at it, it might be a bifurcated year. So let's just take it in a chunk for the first 6 months of the year. And the reality is that earnings per share revisions for AI type of CapEx spending and these type of companies in tech, large cap specifically, has been off the charts better than anywhere else. And I think that continues. And so even though there is some negative sayings out there and it's people worried about valuations, we just talked about 65%, you know, that's the company releasing how much NVIDIA is going to be up. So in reality, I think that this continues. And yeah, there's going to be a little bit of volatility, but I think you want to be in some of these Mag 7s. I think you want to be in this AI trade still.
Yeah, and we should differentiate a little bit between one and the other, because the AI trade has a basket of outperformers, whereas the Mag 7 has been, you know, there's some outperformers, there's some kind of in ho-hum, there's some laggards this year. So you like Microsoft, you like Google, you would sell or avoid Tesla. Talk about that.
Yeah, well, you know, there's a lot to like about Microsoft, one of my preferred Mag 7s, and you're right, it plays in both the AI a little bit and as well as the Mag 7. It's high quality earnings, and with that AI tilt, I like that. Google has their own things. We know they're exceeding on return on equity, high profit margins, etc. But Tesla is my least favorite. And I think you're paying for a lot of volatility. They've had some negative earnings per share. I don't think the real AI is going to be taken advantage of here for Tesla. So the other thing is that I love Elon Musk in the sense that he's going to let us know. I've always said this. He's going to let us know when we need to get long Tesla again. And right now, he's not doing that. So if he's not doing that, I'm not doing that.
Wait, to elaborate on that first, because I love talking and debating Tesla. Obviously, people have very strong opinions about it, but you have to respect the stock being back at all-time highs, even after he exited the White House, with all the ups and downs they've had. And with it's obvious we're now getting out of the mushy middle of driverless cars to them really going mainstream. And that must benefit Tesla substantially in the years ahead. So why are you a little bit more cautious about it? And what are you waiting to hear from Musk himself?
So that's a great question. First, Tesla's up today. It's doing well, and you're right. It's hitting some all-time highs. I think that it's in the right space. But if you look at capital and spending capital right now, I'd rather be in some other AI-type tech companies if I'm in that space, or some Mag 7 if I'm in that space. And what I'm looking for Musk to say is that he's back involved and that this is the future. He's always been very, very good at telling us his vision and how he's going to be better than others in the same space. He hasn't said that for a while. I'm waiting for him to say that.
That's interesting, because I always feel that he's out there every day with a message on X about this or that. But you know, to be fair, I can't think of an explicit comment he's made recently other than that. I wouldn't say he's projecting a message of low confidence in the company, would you?
Oh, absolutely not. No. He wouldn't put in that package for him if there was low confidence. So
right,
I do agree that
exactly.
I don't think he understands the definition of no confidence. He only has confidence. But the reality is that you have to put money to work. And I think there's some other bets right now that are less volatile, that probably manage your risk a lot better, and yet you still have exposure to tech and to growth.
All right, fair enough. David, thanks so much. Really appreciate it today.
Thanks for having me.
David Hardin with Summit Global Investments. Speaking of Tesla, coming up, we're going to talk about San Francisco's power outage over the weekend that wreaked some havoc on Waymo robo-taxis, the details, and how Elon Musk is responding ahead. And as we head to break, check out Airbnb on pace for its 10th straight positive day, extending its record win streak dating back to its IPO 5 years ago this month. It's up more than 12% over this recent period for its best 10-day period since February. We're back with more right after this. Stocks are starting the week in the green with the Dow and S&P trying, forget this, their 8th straight positive month, Dom Chu, which would be their longest streak in 8 years. More on that in the day's other biggest movers.
It has been quite a rally for sure, but let's start things off with a headline news piece that's driving some of the market action, and that's shares of Dominion Energy, which are actually down 5.5%, taking a hit, one of the worst performers in the S&P. That's after the Trump administration halted further development of wind projects, including the Coastal Virginia offshore wind, which is the biggest project of its kind in the entirety of America. Dominion Energy is actually the utility company responsible for that project. 4 other wind projects are also having their leases paused. Interior Secretary Doug Burgum said the move was due to needing some time to assess possible national security risks, so keep an eye on Dominion, down 5.5%. Moving on to another headline mover. Shares of UK-based fund manager Janus Henderson higher after it agreed to be taken private in a deal involving both Trian Fund Management and General Catalyst. They will pay $49 a share in cash to take him over. That's roughly $7.5 billion. News of that deal was reported back by the Journal on October 27th, which sent those shares higher, so we can see Janus Henderson up 3%. And we'll end with another deal. Shares of Coinbase are higher after the crypto exchange operator announced it would purchase startup predictions market platform, The Clearing Company. Coinbase says the deal will help it scale up its presence in the red-hot predictions market industry and help it grow towards becoming a multi-asset exchange operator. Those terms were not disclosed, but Coinbase shares up 2%. I'll send things, Kelly, back over to you.
Makes sense. I think we're going to need some regulatory clarity on this front with all of this action. Dom, thanks very much. Let's get to Christina Partsinevelos for the CNBC News Update. Christina?
Kelly, a draft Pentagon report on China's military ambitions reportedly says that Beijing has likely loaded more than 100 intercontinental ballistic missiles into 3 silos. That's according to Reuters, which also says the draft report argues China has no desire for arms control talks. The Chinese Communist Party has called reports of a military buildup, quote, a smear to defame China and mislead the international community. Uber and Lyft will both start testing Baidu's robo-taxis in London next year. Lyft made the announcement today. Uber announced its plans just last summer to test vehicles there as part of its own deal with Baidu. Lyft's CEO posted on X today that it will start testing once it gets local regulatory approval and plans to scale to hundreds of Baidu's EVs just there, but he did not give a timeline for the commercial launch. And the NBA announced today that it's moving forward on a joint plan with the International Basketball Federation to explore a new professional men's league in Europe. A person familiar with the matter tells CNBC Sports that franchise values could be upwards of $1 billion, or at least $1 billion. Not bad.
I mean, all their star players are from Europe. It kind of makes sense on some level. Christina, thanks very much. Coming up, the metals are enjoying a nice run to end the year. Gold is up 6 months in a row for the first time in more than 2 decades. Will this momentum carry over into 26? We'll ask our trader and get the stocks on, oh yes, his naughty and nice list. Stay tuned. Gold and silver are at it again, both hitting fresh highs again today. Gold's up 70% now this year. It's also on pace for its 6th straight monthly gain for the first time in 23 years. Don't these stats make you itchy? While silver has more than doubled, it's up 136%. Best year since 1979. Will this rally continue into the new year? Let's ask Tim Seymour. He's the CIO of Seymour Asset Management, a CNBC contributor. And you have some kind of clever ways for those who don't want to have to make a call on this one way or the other. One of your stocks in particular. Am I going to, am I jumping ahead here if we talk about Rio?
Jump anywhere you want.
Do you want to start with just the metals?
Well, and I'm thinking about it. It's Christmas Eve, and we got Burl Ives going silver and gold over and over.
Gold.
You could,
yes, we've been talking
you
about
might want
this.
to quit your day job. Don't quit your day job.
But I liked also what we heard last hour, where they were talking about, look, gold might have strong fundamentals in the case of central bank buying. And Jeff Curry last week was saying, look, he thinks a lot of these metal trades are going to ultimately play catch up to establish their historical ratios. He likes platinum, so that also the EU is relaxing its kind of switch over to away from combustion engines. That'll favor it. So do you think everything else plays catch up to gold? Do you think the whole thing needs to take a pause here? Is silver more speculative, or does it have a better usage case? I'm just curious.
So it has industrial use, but I love gold. I think gold's 6,000 by 28, if not before. We know the central bank narrative. We know the asset class narrative. Morgan Stanley out there saying it could be up to 20%. I don't know. I do know that the deficit side of gold is also not as understood. A fun fact that many people maybe have heard, you've probably heard this, but all the gold ever mined could fit on a football field 2 to 3 feet high. That's it. Yeah. And there's not new supply. New mines take 6 to 9 years. We love to talk about that. We'll probably talk about copper in a second. We'll talk about copper. It's all, on some level, there is an industrial metal story that follows. Some of this is Fed driven. Some of this is deficit story. Some of this is kind of central bank dynamics. I think as you get into copper, it's a case where there really is a deficit dynamic. We heard this morning from Antofagasta, which is one of the largest Latin American copper producers, in their sales to China, that the processing fee, they've cut that to zero. You only do that when there's really tight supply. So what's going on in copper, combine that with some global cyclicality that I think is probably better than people had expected. I think copper and I think industrial metals are following, and yes, silver has industrial use, but I think some of this is just a silver catch-up trade to relative historical.
So you think it keeps going? Let's move that along then to your nice and naughty list.
Yes.
On the nice list, one of the names is Rio Tinto. It's up 36% this year. I mean, it's not as good as silver and gold, but it's something.
No,
Why do you like this one?
It's like you, Kelly. Nice this year, probably you'll be nice next year.
Thank
That's
you.
who you are. I think Rio, the story is coming around both in terms of the copper production. This was at 1.15% of the top line. It's probably going to be closer to 40 out a couple of years. They have the fastest copper growth of the integrated miners. I think if you look at also just where they are selling iron ore and some of the core other parts of the bulks that they're involved in, this is a company that I think is almost intrinsically cheap to the underlying.
We've heard of people making the case for Freeport. I don't know if you would say, yeah, one or the other, if you feel more strongly about Rio or...
I feel very strongly about Freeport, too. I'm long Freeport. You can get the copper miners ETF, COPX, and if you look at, that's a great looking chart for the reasons we're talking about. I like Freeport. Also, Freeport has gold exposure as well. What I like about Rio is it pays a really nice div, which isn't a reason to buy a stock, but the capital discipline for them is extraordinary. I think you have upside optionality on China. If you get anything in terms of an uplift in the macro in China, this has always been a big part of the story, but more importantly, this is actually a balance sheet that's never been better, and I think it's the best of the diversified market.
This is right. I do wonder about inflation next year, but that's a side note. The one more stock on your nice list, then the naughty one makes me laugh, so I want to get to that. But UPS is one that you like for next year. Again, talk about that one. Kind of a, not a great, look, it's down 20%
Yeah,
year
no,
to
I mean,
date.
this is kind of like, this is the story of my life, like naughty to nice. Like I was definitely at one point, and I think this is a case where UPS is about relative improvement in their core business. What we just saw in their third quarter numbers where, first of all, they beat consensus, they upgraded their 4Q, but actually U.S. margins are going a little bit higher, even at a time when year over year U.S. volumes are going down. That never happens, and it's telling you that they're running this company better. It's certainly cheap to itself. You're also paid a decent div. Again, not a reason I go out and buy companies. I am long this one. But I do think this is about also a macro story. Look at the chart on FedEx.
I was going to ask, would you do that one too?
Well, I think it's getting pulled higher because I think the story around transports remains very constructive. But this is one that really was naughty, and it was about showing the operational improvement, and I think we're there.
It just reminds me, in the spring I was at a supply chain dinner, which everyone will laugh because I talked about it for like a week or two. And everybody said we're going to be in recession by the end of the year, basically. Right. And here we are talking about the upside case for next year. The recession never came by the transports. Like, this was not what most people had on their list, let's put it that way.
No question.
That brings us to what is on your naughty list.
Yeah.
I don't know why we're calling it this. Walmart, okay?
Right.
Incredible performer. Shares are up 25% this year, but effectively this is one that you think you wouldn't put under the tree.
I think less nice equals naughty, and I think it's a case where it's everybody knows it's a naughty valuation. I would just say that all they need to do is, if they do $3 a share by 27, you can do the math on that. At 30 times, it's a $90 stock, and you know, the multiple, I agree, should be larger, but I do.
It's at 112 right now.
Yeah. excuse me, and I think it's a case where it really is a U.S. comp story. And if comps come in kind of low to mid singles, I think that's not enough of a bar for them.
But then Costco got that downgrade the other day. They think their comps are decelerating a little bit. How can both Walmart and Costco?
Well, I think part of the naughty call and Walmart, the stock, not in terms of the company, because obviously they're executing and they're going to continue to. And I have a position in Walmart, but I think on a relative basis, that's the story. And I wonder whether what's going on with the Costco chart is a function also of a multiple catching up to a stock eventually.
Right.
And I think you might see some Walmart follow through there.
Heretical. Tim,
Who
thanks.
knows?
Appreciate it.
Thanks.
Tim Seymour. Coming up, a blackout over the weekend, plunging 130,000 San Franciscans into darkness and stalling the city's Waymo fleet in its tracks. We have those details when we come back. Waymos are up and running again in San Francisco after a Saturday blackout stopped the robo-taxis in their tracks throughout the city. Deirdre Bosa digging into what it means for the robo-taxi rollout more broadly in today's Tech Check. Deirdre?
Hey, Kelly. So let me just show you. These are scenes from Saturday night in San Francisco. You might have seen them on social media or scenes just like this. So you essentially had Waymos stalled in intersections across lots of different streets, backing up traffic across different parts of the city. Now, the vehicles, they're designed to handle dead traffic lights and keep moving even without a wireless signal. But when multiple systems failed at once, the response was maximum caution, and that quickly turned into gridlock. Now, it all signals just how high the bar is for Waymo. It's essentially pioneering a new driverless system under full regulatory and public scrutiny. So the tolerance for error, as we've seen, is close to zero. That kind of pressure has really shaped Waymo's strategy, Kelly, and it highlights the different route that Tesla has gone. It is trying to build autonomy that behaves more like a human, one that can improvise amid ambiguity, like a blackout. For example, Tesla, under its technology, may read eye contact, edge forward, make a judgment call without perfect signals. And that way may come with safety trade-offs because it's asking the system to make judgment calls with less certainty. If that works, it could scale faster. Now, Waymo has the momentum right now. It's raising new capital at a $100 billion plus valuation. It's expanding to lots of new cities, as you can see on this map here. The company says that it is focused on rapidly integrating the lessons that were learned over the weekend, but this incident really does put a spotlight on whether scaling means careful city-by-city expansion that Waymo has been working on, or systems more like the one that Elon Musk is working on that can adapt in real time and behave more like a human.
So why did the Waymos stop working? You'd think a San Francisco power outage, I guess in my head, I think they run off of data centers that could be in Northern Virginia, right? I mean, I'm so surprised that this happened.
I mean, that is something I've been trying to get to the bottom of. I have emailed and called different people at Waymo several different times. They kind of keep saying that, you know, they point to an example when it stops at a red light that isn't working, it treats it like a four-way stop and is extra cautious, so they all just stop. But, you know, this video that we're watching, we saw Waymo sort of just stop in the middle of the street and middle of intersections, doesn't quite explain it. And so the only kind of conclusion that I can come up with, Kelly, is that they're not generalizing very well, right?
Right.
It all just shut down when there was too many variables that
so
went awry.
And so the argument that Musk is making is that this didn't happen with Teslas, but
not a fair argument. Because Tesla does not have a robotaxi network here in San Francisco.
A driverless
I know,
car.
Cue the chorus that's going to like crucify me for saying that, but they don't. There is no robotaxi network here without human drivers. It's just a fact, okay? They're safety drivers. It's not an apples to
So
apples
we don't know
by any means.
So they do have robotaxis. They have Tesla robotaxis in San Francisco, but all of those robotaxis have a human driver. So we don't
They
know.
have full self-driving, which is it's autonomous driving technology that requires someone behind the wheel. So we don't actually know what would have happened necessarily if there was no driver and what all the Teslas would have done. But I will say the strategy, right? And this is where the key difference comes up.
It doesn't sound
Is it supposed to act more like a human?
It doesn't sound like the Tesla robotaxis stopped at all. It's not like the human driver is saying, "Oh, I had to take over." It just sounds like they didn't have any issues.
We don't know. That's right. And I think, but it's different, right? Because there was a human driver. We don't know if the human driver had to take over, right? It's different, and it could have sort of stopped out. But this is, the Waymo is sort of a true, no human driver at all.
Have
and
you
that's what we
checked,
know shut
Deirdre,
down.
your percentage of times that it's an FSD? I know that's an option now. It can tell you.
Yes, okay. I will say I'm really impressed with FSD. I use it. I use it on the highway to come into work across the Golden Gate Bridge. I'm really impressed. It's not perfect. I would never sit in the back seat and have it take over at this point, but it is impressive.
If that's the bar now, we've come a long way. Deirdre, appreciate it for now. Thanks. Deirdre Bosa. Thanks. Coming up, Loop Capital upgrading this retailer today whose shares are down 10% this month, and investors could be underestimating its ability to comp the comp next year. We'll reveal it next on The Exchange. Welcome back to The Exchange. Our next guest just upgraded Ollie's today as he expects the trade down to continue next year, despite these hefty refund checks that are coming. Joining us now is Loop Capital's Anthony Chukumba. Anthony and others on the street feel differently and are more concerned about the stock's prospects. So tell us what you expect.
Sure, absolutely. So I think that, as you said, I expect Ollie's to be able to comp the comp in 2026. I think that there's too much concern about the tough comparisons that they're going to face. And it really, to me, comes down to four different factors. First off, they are going to continue to benefit from the Big Lots bankruptcy. And a lot of that is going to be access to merchandise. I mean, folks who are supplying Big Lots now have this big hole to fill. The second thing is that the management team, I just really feel like they're much more scientific and data driven compared to their predecessors. The third thing is that the macro environment remains quite challenged. So I do think that they will benefit from a trade down. And the fourth thing is that they are carrying more consumables, which I think drives more consistent store traffic.
Yeah, apparently the food is actually a big kind of business for them. Jeffrey says they're in the danger zone. Why you don't share any of those concerns?
Well, I don't know exactly, what Jeffries wrote in terms of that being in the danger zone, but I'm not terribly concerned. I mean, look, I think all they really have to do is comp the comp. In other words, the more that folks see that this is a company that can consistently grow their comp store sales, and by the way, they just have to be low single digits from my perspective, and then you kind of marry that with continued square footage growth, continued margin expansion, and the stock will work. And, part of the reason I feel very strongly about that is because other comparable companies trade at 30 times earnings.
Right.
And before our upgrade, these guys are trading at more like 24, 25.
Yeah, Tim Seymour just put Walmart on his naughty list, says it's too expensive, and maybe Ollie's would be an example of one that's not. You think the consumer's going to do well next year, or are people getting too hyped up about this?
Certainly in early 2026, we are very optimistic about higher income tax returns. And remember, with this core low-income consumer, if they get a bigger tax return, it's not like they're going to save it, they're going to spend it. And so we definitely see a significant tailwind for Ollie's in early 2026 from those tax refunds.
All right, Anthony, a pleasure. Thanks so much for joining us today.
Anytime.
Anthony Chukumba at Loop. And that's it for us. Thank you for watching The Exchange. I'll join Brian Sullivan for Power Lunch right after this quick break.
Stocks are up to kick off your shortened holiday trading week, but the White House knocking the wind out of some big energy stocks. Welcome to Power Lunch, everybody. I am Brian with Kelly. Energy in focus, tensions with Venezuela continuing to rise, and the White House going after big wind. The U.S. Coast Guard chasing a third oil tanker as the Department of Interior turns off the power to a number of big wind energy projects. At least for now, some of those stocks taking a hit.
Plus, big tech has powered the markets to these record highs, but will those stocks deliver next year? Our markets guest will lay out his playbook and why he says it will be a unicorn year for investors. Is that an IPO reference? Speaking of big tech and energy, Alphabet making a multi-billion-dollar deal in AI energy. RBC's co-head of global M&A is here to discuss that and more.
Yeah, look forward to chatting with Vito Sperduto here in a few minutes. We have got a lot to do over this hour, but let us begin with your money. Because right now, like literally today, is the time the so-called Santa Claus rally tends to kick in. It's really the last few days of the year and the first couple of days of the new year. Historically, we see stocks pop, and that's exactly what we have right now. The Russell 2000 is up 1.3%, NASDAQ up about 0.5%. But that's today. What about the next few days, the next few weeks, the next year? Well, many on Wall Street think the rally can keep running, but not everybody. The FT reporting that Apollo boss Mark Rowan is cutting risk and building up cash. He told investors this month his number one job was to have the best balance sheet possible and to position Apollo to make money when something bad happens. In other words, sounds like Rowan's acting a bit like Warren Buffett, kind of saving money to buy if and when prices go down. Should you do the same or just go all in right now? So that's Tim Urbanowitz. He is the chief investment strategist at Innovator Capital Management. Tim, I've got to imagine, listen, that's Apollo, they've got their own thing. But it can't be a bad idea for your clients to have a little cash. What do they call it? Dry powder? Kelly said, when things go down, they can buy them, or should they be 100% invested right now?
Well, Brian, you always want to be focused on managing risk. That is front and center no matter what we're doing, especially when we look at the outlook season. But Brian, we also think this year is going to be a very special one for investors where consumers get back in the driver's seat. We're viewing this as a unicorn year, okay? You have a situation.
What does that mean?
Well, investors are going to be double dipping on tax cuts. You look at what's coming from the big, beautiful bill. They're going to be benefiting retroactively from 2025, which, by the way, that money is going to be coming in February through April. And on top of that, you're going to be benefiting from less withholding in 2026. So that's a unique environment we think puts consumers in control. Spending's driving this economy, and something that can push the S&P 500 higher. We got a target of 7,600.
Yeah, I wonder, it's gone from the last couple of weeks going, wow, did you know these tax refund checks are coming? Wow, did you know now I'm hearing it from everybody. So I'm not saying it's hard to invest when sentiment can swing that wildly, but do you think people are getting too bulled up now about the consumer in the next couple of months?
Well, I do think you're starting to see that change. If you look at consumer confidence, it's been down in the drain. It's been terrible. The last print in December looked positive.
Well,
better.
Yeah.
So we think that trend is going to continue with these tax cuts. And if you look at different sectors out there, discretionary, staples, these are sectors that haven't done much of anything this year. Outside of the value plays where customers are value hunting, they haven't done much. So we think this really can breathe some life back into those stocks.
And I appreciate, we were just talking, Tim Seymour had some skepticism about Walmart, more valuation. Sorry, you like Home Depot, Walmart, even Target turning it around. It's coming off that 12-day win streak. But you know what I can't get out of my head? $50,000 is the average price. Is it a new vehicle in this country? I think a new vehicle. I think not just any vehicle.
Yeah.
Home prices, as we know, are way high, up 50%, since 2018. So even if we're getting a little extra money next year, do you think it's going to help enough that it meaningfully changes the trajectory and this affordability crisis that people perceive?
Affordability is the number one issue. It absolutely is. It's certainly been a problem. I think that's why we've seen the confidence that has been beaten down so bad. But the other thing we have to keep in mind is we're getting to a point right now where we're starting to see the impact of the Fed cuts that have taken place over the last year. Plus, they're starting to make their way into the economy. Hopefully that helps with home prices. Obviously, Fed doesn't control the longer end of the yield curve. They don't control the 10-year. So we need to make sure inflation's coming under control. But the other thing that we see, and you tend to see inflation that follows wage growth. And we've seen wage growth start to come down. So that makes us much more optimistic on the fact that we can continue to see inflation coming down and really provide some relief to consumers. Obviously, mortgage rates are a big piece of that. That to us is still a big question mark, but there are some other bullish signs out there.
Well, you are making a pretty strong bull case for the American economy. You're bullish-ish on the stock market. 7,600 is 11%. Historically, the market returns about 8% a year. Throw in the dividend yield, you get to about 11%. So you're optimistic, but you're not wildly optimistic, it sounds like. You're not saying, oh, we're going to be up 30 or 40% next year. It's 4 year, because we've been in a 3-year bull run. I don't need to tell you, that's been pretty incredible.
It has, Brian. And if you look at the breakdown of how bull markets play out, early on, we see valuation expansion drive the rally. That's exactly what we've seen this year, the first couple years. This year, we've seen that baton start to pass to earnings growth. We look at 2026, it's going to be all about earnings growth, okay? Because the starting point is so high. And so the reason I think our target is not 20% higher from here is because we don't think you're going to get that boost contributing from valuation expansion. It's going to be all about earnings growth. And that's what we want to be laser focused on, because we just don't see that. We actually think valuations are going to contract slightly this year.
Why is that? Even if interest rates are coming down?
Well, they're just so high to begin with, okay? And that's typically, if you look at year 4 of a bull market, okay, more than 100% of the return in year 4 of the bull market is driven by earnings. Valuations tend to
Do they
contract.
end after year 4, by the way? Everyone's talking like this is the last year. That I don't think they go much beyond 4 years.
38%. We look at every bull market since 1950, 38% make it to year 4 and produce a positive total return.
Wait,
in that 4th
only
year.
38% of them make it to year?
About 50% make it to year 4, 38% make it to year 4 and produce a positive total return in that year. So are we going to be positive this year? Yeah, 38%
So
chance.
it's actually a coin flip whether this coming year will be positive by historical standards.
Yeah, it feels a little bit like a Yogi Berra market. Nobody goes there anymore. It's too crowded. And I think that to me, I feel like is the risk for this coming year, which is that everybody I know has made so much money in the stock market, they love it, but they're jumpy about next year because the longer something goes on, you just naturally as a human being get nervous. You're like, I can't keep winning, or maybe they can.
Oh, Brian, I was in last week out in Oklahoma talking to some of our clients, financial advisors, and there's a lot of them that are just kind of waiting for something to go wrong. It feels too good to be true. There's a lot of concern around this AI spend. Are we going to be heading into a bubble? That's not our view, but there's nerves around it. And I think the big thing we want to stay focused on for next year is those nerves are probably going to produce some pretty big bursts of volatility along the way. A bad earnings report, you think about Oracle just a couple weeks ago, it spooks the market. It spooks that AI trade. And we think there's going to be some good buying opportunities presented on those spurts of volatility next year.
What were the names? Walmart, Home Depot, and even Target.
Which is one, as you know, Brian, we have been pretty bearish on all year. And we think that trade is going to spread out. This year, when you look at a lot of those consumer stocks, the ones that have been winning have been the ones that have been putting things on sale. They've been really picking up a lot of that trade down, those bargain hunters. But again, with the tax breaks, a lot of the money going back into consumers' pockets, we think that broadens out. More spending on your home, more spending on those core goods.
Listen, if the Bears can win a game, you're a Chicago guy now. If the Bears can win a game off recovering an onside kick while down 2 touchdowns, anything's possible. I'm just annoyed that I bet on the Packers. Tim Urbanowitz, Innovator Capital Management, Chief Investment Strategist. Tim, thank you very much.
Great to be with you.
All right.
Appreciate it. Let's check on yields for you as we're still following the sell-off in Japanese bonds as it reverberates worldwide. Like the 2-year yield, more sensitive to monetary policy, hit 112 today. And Brian, that's the highest level for Japan's 2-year since 1997, okay?
What?
The benchmark 10-year, 2.095. That was last seen in February of 1999. So the renewed sell-off in sovereign debt following the yen's continued weakness, even after they delivered that rate hike on Friday. We're talking about the highest level in 30 years and ones that are pushing up yields as well. So it's not just monetary policy here moving the 10-year around. They're fighting against these larger forces as well.
This could be a good topic for the Kelly Evans newsletter.
Thank you. I'll ask her if she has some time to put that together this week.
When you get a hold of her, let me know. Thank you. All right, we have got a lot more to do, and after the break, we are talking energy, the administration going after Venezuela and big wind, the impact its moves could have on the price of crude, energy names, and more next. right, now to a story that is grabbing more and more headlines. Our government is going more and more after Venezuela's money and its oil. The U.S. Coast Guard seizing another sanctioned oil tanker off the coast of Venezuela over the weekend and reportedly now pursuing a third sanctioned vessel. As a reminder, the key word here is sanctioned. Not all ships are subject to search and seizure by the United States. Only ships that are doing business with sanctioned nations like Russia, Iran, and more. The first tanker was seized about 2 weeks ago. It's called Skipper. There it is, that flashing dot. That's the ship right now, as shown by Marine Traffic by Kepler. And that ship currently being held off the coast of Texas, about 50 miles off the coast of Galveston. This crackdown on Venezuelan oil is also hitting one of Caracas's closest allies, Cuba. Without Venezuelan oil, the country faces an increasingly dire economic situation because it relies heavily on Venezuelan oil to make electricity. And now blackouts are growing more common. Let's talk about this and more and get critical analysis with retired Colonel Jack Jacobs. Colonel Jacobs, it's great to have you on, although I feel like when I have you on or when we talk to you, it's because there's something that's very tense in the world. Do you think it is possible that the United States will go to some form of a physical war with Venezuela?
It's unlikely. It's difficult to envision how we would do that. I mean, we've tried that in other countries down through the ages and have never been satisfied with the results. We're there in Vietnam, or did it Iraq, Afghanistan, and none of that stuff turned out very well. I think the most likely event is that we will continue to harass the shipping out of Venezuela to intercept sanctioned vessels and make life extremely difficult for clients of Venezuela for a variety of reasons, not the least significant of which is something that you mentioned in the intro, and that is that the government would dearly like to have access ultimately to Venezuelan oil. And Venezuela, as we know, has, if not the most, certainly among the biggest oil reserves in the world. So that's one of the principal reasons we're going after it. And a lot of the other stuff that we see is theater and ancillary to the true objective, Brian.
Well, to your point, I mean, we have these odds on Kalshi now that we can track. Colonel Jacobs, it's Kelly here, and it says, what do you think the odds are that, Maduro's out by February? And it's only around 20% right now. 20% before Feb, maybe they rise to 50-50 by May. The fact that we're even betting on this, I mean, people understand that something is stirring, right? So where would you direct our attention to next?
Well, one of the things to keep in mind about all this is the old adage about the dog. Once the dog's chasing after the car, when it gets the car, what does it do with it? Unless there's some kind of plan for governing Venezuela after Maduro leaves, to the extent that he does leave, all this doesn't make a great deal of sense. We have to keep in mind also that one of the things we're attempting to do is influence others other than Venezuela here. I mean, the large majority of Venezuela's oil, as you said, a lot of it goes to Cuba.
Exactly.
Some of it goes to China. But at the end of the day, it's not a big player in the market at the moment, at least partially because of the strictures that we put on Venezuela.
But do you think, in other words, that this is about Venezuela specifically? Is it also about Cuba? Is there a plan right now for what happens if that country is pushed to a brink? Because, I'm just looking at the front page of the Wall Street Journal today talking about it. You mentioned China. Obviously, that's a leverage point as well.
Yeah, there is no plan that has been articulated. It's difficult to envision what happens on day one after everything falls apart, what happens inside Cuba. I mean, we have better relations now with Cuba than we've had since 1959. But we're talking about governance here. Who's going to govern Cuba? Unclear. Who's going to govern Venezuela? We know about Maria Machado, but at the end of the day, does she really have the structure behind her to actually govern Venezuela at a time after which Venezuela is actually going to go to pieces? There'll be difficulty in the streets.
Right.
So what's happening here, a lot of it, like I said, is theater. A lot of it has to do with demonstrating that the United States has a great deal of influence in this hemisphere, and also to make life extremely difficult for those who are beneficiaries of Venezuelan oil, Kelly.
Yeah, and yet I hear, as you say, you're not sure what the plan is. And so I think the market is waiting for that. Fortunately, oil prices are low, so it's not as if this is really hanging in the balance. But Colonel Jacobs, thanks very much today. We appreciate it. We have oil prices, as mentioned, moving a little higher, up 2.5%, but they're on pace for their biggest down year since 2020. In fact, an ounce of silver is now worth more than a barrel of oil. So what does the situation in Venezuela mean for the energy market? Let's ask top oil analyst Paul Sankey, president of Sankey Research. Paul, it's good to see you. And how are you thinking about the events in Venezuela, Cuba, as it relates to the oil price?
Yeah, I think the market perceives it to be potentially bearish, obviously, if you were to change regime and then open up. But of course, it's going to be a knee-jerk reaction. The reality of the barrels coming back to the market will likely take much longer, but certainly the immediate reaction would be negative as regarding the potential for more supply from Venezuela.
You know, it is interesting, Paul, that we're talking about possible regime change in Venezuela. We're boarding oil tankers, we're rerouting the oil to Texas, and the price of oil is up, yeah, a couple percent, but it's still at $58 in the United States. That alone is probably the biggest message, I think, about oil inventories and the state of psychology around oil right now.
Yeah, and as you know, Brian, we've thrown everything at this oil price. We really have. I mean, you've even got in the background here more talk of Israel, Iran, just to add to everything that's going on. And of course, as you well know, there seems to be a significant issue with Russia, Ukraine. So it is disappointing, and it just tells you how much supply is out there.
You know what is, I think, maybe the most surprising thing in the markets, obviously the Venezuela news aside, Paul, is that when I look at my screens, I'm looking at a BP, just got a new CEO. Stock's up, 18% this year. Shell is up about the same this year. Total Energies. The European majors, which people wrote off as dead because they were making all the wrong moves, they have made investors a lot of money this year. Comment on that, and then also what you see or what you think might happen in 2026.
Well, as you know, Brian, there's been a significant rally in European stocks as well. I mean, if you had been long Rheinmetall, for example, the German defense company, you would have outperformed Palantir this year. So, yeah, they've gone up. I don't think investors are terribly enthusiastic about them. But yeah, there is change there. And I think generally the market has begun to think about the next phase of the oil market post-oversupply and actually started buying into the oils. You can see it in a very levered name like Transocean rig going up in the fourth quarter quite a bit as people are doing a very contrarian trade, basically, quite frankly.
Yeah, Paul, I do find it a bit odd when I stand back and look at all of these trades. You have all of the metals flying, which are in various parts of we're going back to internal combustion engine, a la, platinum, that's Jeff Curry's pick. The economy's not in recession. There's demand for everything. We're ending the energy transition to some extent where it's not as aggressive as it was a few years ago. So where's the bid for oil? It seems like that's the last logical part of this story. I hope it's not. As a consumer, I'm happy to pay lower gasoline prices, but I understand those who say it's going up next year. Why is the market perceived to be in a glut of oil, and how much longer can that glut last?
I think it's the supply side. I think that these metals that you're talking about have supply issues clearly, and as you say, there's a lot of demand, massive demand for them, and that's the balance. Whereas in oil, if you think oil is cheap at 60, try natural gas at 4. That's $20 a barrel of oil equivalent. So the supply side is abundant here, and I think additionally people don't tend to think too hard about technology, which obviously relates to the supply side and the ability of these companies to continue delivering. As you know, U.S. production up still with a much lower rig count is telling you that productivity is strong in the supply side.
And it can remain so, because that's kind of an argument against owning some of these stocks.
That's the $6 billion question, is when will we see the rollover, particularly in U.S. supply? Absolutely, because as we've said, there's a lot of issues around the world with, Russia is formerly the biggest producer in the world, one of the top 3 biggest producers, having major issues. The other thing we haven't mentioned, by the way, to think about with Venezuela is refining. Refining was a huge industry. Venezuela actually has the world's biggest single refinery. It doesn't run, but
it doesn't run.
No, I shouldn't laugh. It's over 1 million barrel a day of capacity. So yeah, it's another angle. And then I think the other one that confuses me is just the whole Cuba angle and where the administration is going with this. It's been a bit of a surprise that that there has been this issue going after Venezuela to the extent they have. quite frankly. And it seems that there's a Cuba angle here as well that you've referenced.
Yeah.
One wonders if Cuba will help us resolve the Maduro issue.
Just to be clear, by the way, Brian, I should say that a source in the State Department told me that this is about lowering the oil price. I mean, this was obviously off the record, but that's what I was told. The Venezuela thing. So, yeah, it is pretty bearish.
Yeah, more oil. But to your point, you do wonder, when do the U.S. companies react? Because the Trump administration also doesn't want to have job losses because things slow down in the Permian Basin. Paul Sankey.
Yeah, I mean, by the way, the Texas economy has been the driver of the U.S. economy. So the idea that low oil prices will be great for the U.S. economy is not something that I buy into. I think we need oil more in the 60+ range for a really healthy U.S. economy, because as was referenced by Kelly, the U.S. consumers aren't struggling that badly at the moment with the price of oil.
Always well said, which is why, Paul Sankey, we have you on. Sankey Research. Paul, great stuff. Happy holidays. Thank you very much.
Happy holidays. Thanks, all.
All right, staying on energy, because there's also another story out there, a huge hit to wind energy off the American East Coast. The White House stopping 5 big projects currently under development. The Department of Interior saying, quote, the DOI, Department of Interior, announcing today that it is pausing, effective immediately, the leases for all large-scale offshore wind projects under construction in the United States due to national security risks identified by the Department of War in recently completed classified reports. This pause will give the department, along with the Department of War and other relevant government agencies, time to work with leaseholders and state partners to assess the possibility of mitigating national security risks posed by these projects, end quote. Now, it is unclear, because it's classified, specifically what those national security risks are. Obviously, we are working to find out more, but the impacted projects are Vineyard Wind 1, that is off the Massachusetts coast. It's half owned by Avangrid, which is part of Spain's Iberdrola. Revolution Wind, the Rhode Island project run by Denmark's Ørsted. The Coastal Virginia Offshore Wind, owned by Dominion Energy. Sunrise Wind, another Ørsted project, this one off the coast of New York. And Empire Wind 1, a New York and New Jersey project run by Norway's Equinor. Ørsted stock, by the way, tumbled in trading in Denmark. GE Vernova, by the way, is involved in some of these projects by selling its turbines to them, but that stock is actually higher right now. It's not a big part of their business. Now, it is important to note, this is only a pause, and the pause lasts 90 days. Now, it could be extended, or it could end after 90 days, and these projects continue. Obviously, we are out to all relevant parties.
Yep. After the break, Tesla hitting a new record high today. Our market navigator is looking at options on the shares for clues about its future trajectory. And we'll have that story next. Welcome back. We're seeing a pretty nice session today. The Dow's up 234, just off session highs. The Nasdaq's up 0.5%, helped by some revival in the AI trade, and the small caps are actually leading the way with a 0.25% gain. Let's go to 1.25%. She tried to say. Dom Chu, what's in Market Navigator today?
We knew what you were trying to say, Kelly. We saw it on the screen there. So one of the other stocks here that's helping to kind of move things around a bit is Tesla. It hit a new record high today after the Delaware Supreme Court on Friday overruled a lower court's decision to avoid Elon Musk's controversial pay package, which includes 300 million stock options. Tesla shares have been outperforming other Mag 7 stocks this month, so our next guest is bullish on the name still and thinks shares still have plenty of room to run in the new year. So joining us now to make the case is Danielle Shea, Vice President of Options at Simpler Trading. So Danielle, the record high, I guess it's one of those situations where momentum begets more momentum. Why do you think you could see higher prices in Tesla shares in the coming weeks?
Well, that's exactly it. Once you see a stock break a previous all-time high, which it did last week, on high volume and momentum, and you still have buyers coming in, that's exactly a situation where we could keep going higher. So we do have, however, if we could just break through that $500 level with high volume, then I think we will trade up on into 520 and then up into 550.
Now, Danielle, what hotspots are you seeing? Where is there the most activity around certain strike prices? What kind of open interest tells are out there? What makes you think that you could see some magnetic movement towards some of these levels?
So there's a significant amount of high volume and high open interest at the $500 strike price in Tesla in multiple series. So for that reason, typically in the options market, especially in short-term trades, I like to use that as a price target. So, we'll use debit spreads, we'll use butterflies, that kind of thing to target that level. But what's the most magical and what I love the most about Tesla is that when it does end up breaking through those zones, you really get that volume and momentum that just keeps going, which is kind of what we saw in September and what we've seen throughout this rally. So, I'm going to continue using the $500 strike price, next 520, and then after that 550, because those are those magnetic zones in Tesla as it continues to trade higher.
All right, so we'll keep an eye on that open interest and all the activity around those key strike prices. Danielle Shea at Simpler Trading, thank you very much. Happy holidays.
This is where all the chatter is. Good to see you, Danielle. Coming up, NVIDIA reportedly ready to ship its second most powerful AI chips to China in just a few weeks. The shifting policies around chip exports, the timeline of those deliveries, and the risks for the company. That's next. Welcome back. NVIDIA is at the center of the high-stakes trade negotiations with China, and there's a new report the chip maker may begin shipping its second most powerful AI chips to China early next year, marking what would be the first deliveries of those advanced processors since Washington signaled they would allow the sales. But the deal is far from done, and will they get a cut? Christina Partsinevelos has more. Christina?
Well, Kelly, right away, we have to know that the president and the Trump administration is still reviewing the licenses to actually ship these H200 chips. These are the chips you're talking about that are geared towards China. And you said they're a little bit older. They were first shipped in 2024. Nonetheless, there's this report from Reuters saying roughly 40 to 80,000 of these H200 chips will be shipped to China by mid-February, which would be a huge win for NVIDIA because they've essentially said their revenue for China is zero. You have all sell-side analysts that are modeling nothing for China revenue. So this would be a big win. But the reason why we're saying that this isn't a done deal is twofold. The first is that Chinese regulators have pushed back on NVIDIA chips before in the past. The H20 chips, which is a lower, 6 times lower than the H200 chip, they've said that there's backdoor security issues, environmental issues. They're concerned about a lot of other things. So that's one hurdle that NVIDIA has to overcome, even if the United States gives NVIDIA those licenses. The second is maybe NVIDIA would have to bundle these chips with local alternatives. So every time a Chinese firm goes ahead and buys these H200 chips, they'd also be supporting local alternatives. So nothing is concrete yet. NVIDIA is declining to comment on this thus far, but you're seeing the stock up. I think the stock may not necessarily be up because of this news, but rather some positive news coming out of Taiwan about NVIDIA's server racks for next year. It's expected to increase by 129%. And these racks are massive. It's not just one chip. There's a lot of chips. They weigh at 3,000 pounds. Some of these racks cost over $1 million. And they're saying everything is going according to plan. There's no delays. So I think that's contributing to the uptick in the stock.
Yeah, no, I think that's correct. And now, of course, they'll have to see if they can meet those lofty growth expectations for next year with those chip sales and all the rest of it. Christina, thanks. Appreciate it. Christina Partsinevelos.
All right, now let's get over to Mackenzie Sigalos for a CNBC News update. Mackenzie.
Hey, Brian. Kilmar Abrago Garcia is back in court today just over a week after a judge freed him from immigration custody. His case became a flashpoint in the Trump administration's immigration crackdown after he was mistakenly deported to El Salvador earlier this year. The judge today will decide whether he should be returned to custody as the government fights to deport him to several countries in Africa over allegations that he has gang ties and participated in human smuggling. Ukrainian President Vladimir Zelensky said today recent intelligence shows Russia may launch, quote, massive strikes on Christmas. He says Kyiv is now focusing on air defense. Zelensky said last week Ukraine supported a potential Christmas ceasefire, particularly for strikes on energy infrastructure. An outspoken President Trump critic, George Conway, reportedly filed paperwork to run for Congress as a Democrat in New York City. According to multiple reports, Conway will run for the seat currently held by longtime Representative Jerry Nadler, who announced earlier this year he would not seek re-election in 2026. Kelly, sending it back to you.
All right. Thank you very much, Mackenzie. Alphabet announcing a new acquisition to help power its AI. Will the sector continue to fuel a boom in deals next year? We'll discuss that with the shares up fractionally right after this.
Crypto Watch is sponsored by Crypto.com. Crypto.com is America's premier crypto platform.
Welcome back. Alphabet is making a decisive infrastructure play to fuel its next phase of growth in artificial intelligence, announcing a nearly $5 billion cash deal to acquire Intersect, a data center and energy infrastructure company. It's a move aimed at accelerating the build-out of computing power and the generation capacity required to compete in the global AI arms race. Deirdre Bosa has more from San Francisco. Hi, Deirdre.
Hey, so Kelly, this is what it comes down to. Electricity, power, it is now a strategic input in the AI race at large. And so this is really Google and Alphabet doing what it does best, and that's looking for vertical integration. This acquisition, nearly $5 billion for Intersect, it's Google moving to secure its own supply. So it gets at the key question in the AI trade right now as well. Where do hyperscalers get the energy to power all of the AI demand that they are seeing? So chips here, guys, not the only constraint. It is access to the grid. It is permitting. It is power. This very much fits into that theme. And I know this is a chart that Brian will appreciate. The impending U.S. power crisis. I'm going to show you it now. The black line is peak supply anticipated. The yellow is peak supply needed. And that big red box is the gap that Google is only starting to try to fill with its own for its own needs with this deal. And this is not just Google specific. This is what every hyperscaler, even SoftBank, looking to do deals in this space. It's all about securing that supply.
Right. And I wonder, as they do this, Deirdre, if it's, should we expect a lot more to come on this front, or is it just kind of like a small bolt-on type of deal?
Yeah, I think that there's probably more to come. You've already seen a number of these deals with Meta and Microsoft. So there's likely more to come. And again, it's that gap that we just showed you. Every hyperscaler is going to be looking to try and fill that.
And putting that in perspective, we bring that chart back up. So 1 gigawatt, very roughly, is about 750,000 homes, depending on where you live and sort of how much power you use. That's 1,250 gigawatts.
Wow.
At the top of the list. So you go down to the bottom. So we're talking about a gap of, 300 gigawatts. So that is roughly, 21 million homes short of power. Effectively, we're like in Ohio, short of electricity, Deirdre.
Wow.
It's just, thank you for putting it in perspective. That is just such a massive amount. And that's why when Kelly asked, are we likely to see more deals? I mean, the simple answer is yes, because even this one deal, a $5 billion deal nearly from Alphabet, barely does anything when you are talking numbers and scale this large.
What it did do is make the people who founded Intersect really, really rich today. So that's
Kudos
it.
to them.
Deirdre Bosa, thank you very much. By the way, I'm just going to editorialize very quickly here. Some other stocks and companies to watch on this news. These stocks, some of them are on the move. Hut 8, we had their CEO on last week. That stock's up almost 18%. Cipher Mining about 1.5%. TeraWulf was up earlier. Those are also companies kind of similar-ish to an Intersect. You never know, they could be targets. All right. Speaking of deals, your next guest thinks tech and data centers will continue to power global deals next year. But what other kind of companies and industries may also be at play? Let's talk about it with Vito Sperduto. He is the head of RBC Capital Markets U.S. Global Head, Co-Global Head of M&A. Vito, great to have you on.
Thanks for having me.
So what is the deal-making setup heading into 2026?
Sure. Look, if I look back a year ago, we thought the first half was going to be a little slower, just as people got used to the administration and the new policies, and that's what played out. And then the second half of the year, we expected a fair amount of activity. It certainly has exceeded what our expectations were coming into the year. But if you think about the U.S., I call it a great acceleration that just happened in 25. We were basically flat in the first quarter and then ended up about up 59%. Yes, it was driven by large-scale mega deals, but all sectors participated. I think what we're seeing now is that people have kind of worked through the deals that were in the pipeline, and we're starting to see new activity.
How is that activity? Is it strong? Is it mid-level? Where do we stand with, the churning ahead of the possible deals?
Yeah, I think the activity level is across the board in terms of sizes. Certainly TMT, healthcare, life sciences are leading the way. Financial services after that. I think everybody's focused on them, and you just talked about the Alphabet transaction, right? They were an investor in the company ahead of the acquisition. They are clearly buying greater capacity and energy resilience. And if you think about the AI play, it's no longer about the technology and necessarily the availability of capital, because there's plenty there. It's really the energy constraint, as you just showed from that chart, which illustrates it perfectly. And so folks are trying to buy that greater capacity, greater diversity of energy production. And certainly that's a big play for the sort of the AI-centric opportunities. And then when you look at the other sectors, you've always got the healthcare companies looking at patent cliffs and trying to figure out how do I continue to diversify my pipeline, add to it and build to it. You're starting to see the healthcare companies reacting to how the government is changing some of the policy. And they're fairly resilient, and they're going to get there.
Yeah, I think that it was actually a surprisingly busy year this past year. We just didn't have a lot of those high-profile big deals, and then of course along came the WBD one at year-end to kind of just put a banner on things. So it sounds like it should be pretty busy. And do we get finally this IPO wave where it's like, okay, we move from just the private equity-backed exits to the ones that are a little bit more in these hotspots like AI you're mentioning?
I think there's an incredible thirst for the IPO environment to continue to grow. If you look at it, December, this month, is going to be equal to what we had in September, which are the two largest volume IPO months of the year. But over $7 billion of the volume this month is from Medline, which is about 8.6, so 7 out of 8.6, and you can tell. So I think going into the year, there's a fair amount of companies on the sidelines waiting to access the markets, and we're looking at some very notable large-scale situations. But that just improves the environment, because again, it's just another opportunity for them to have a different exit alternative.
What are they waiting for?
I think it's become easier to stay private longer. And so it's really making that decision to access the markets. And do I want to put myself out there in terms of the volatility that I'm going to experience? The size of the companies that are going public has gotten bigger. It's, what we used to experience, like I've been doing this for 35 years, what we had, 10, 20, 30 years ago in terms of what made sense to go public is certainly not the same scale that you need today. I mean, today you need a much larger scale to get public. And I think private capital and the sort of ease of staying private and having more liquidity alternatives has made it a longer timeline. But certainly we're going to see, I think, a fairly robust IPO calendar going into next year. And if we look at the private equity portfolios, there's a lot of assets in those portfolios that need to be monetized. As we think about the lifespan of those companies, they're pursuing all sorts of alternatives beyond just the specific sale of the companies. I think the IPO market's going to provide them another opportunity.
Yeah, you wonder, because employees also want to be paid, right?
Yeah.
And that's a lot of employees that they make less money because the idea is they're going to get a big payday when the company goes public. They're waiting for that. We've got 50%, you've been doing this 35 years.
Yeah.
There are 50% fewer public companies now
yes,
than there were in America than when you started.
Yeah.
Can we fix that, or is this kind of the number where we're going to be?
I'm not sure it's going to diverge much from that level going forward.
3,800 public companies,
Yeah,
roughly.
I think it's going to stay at the lower end versus what we had historically. But I do think there needs to be some adjustments to allow companies to live in a public situation in a much easier context. And I think there's various proposals out there as folks are thinking about it. But today, if you think about it, like if you go back a couple of years ago, private credit was certainly a new entrant in many ways, right? Today it's become a normal part of the financing stream, right? It's a more acceptable. Before it just used to be you can get it done faster. Now it's a clear avenue. But I think when the traditional markets are available, the traditional public markets, traditional bank syndicated financing, folks generally revert back to that. And so we're going to get to see it. I think the quality of what's coming public is going to be stronger. And I think folks are making sure that in this environment, as I go out there, I want it to be well received. And so they watch very closely the high profile transactions.
Like Versant, January 5th.
There you go. I think a lot
very solid company.
A lot of people are tracking the value.
Great hosts on some of their networks. Just
They're
terrific,
wonderful.
Anchor
so
talent.
much value to unlock, really.
So we're just unlocking value every day. That's what when I wake up. Vito Sperduto, really appreciate it. Merry Christmas. Thank you.
Thank you. Great to have you.
Appreciate it.
Thank you.
On deck is something you will only see here on Power Lunch. The single best of Wall Street's most loved stocks this year, and the name will surprise you. That's right after this.
As we head toward the end of the year, it is time to keep score. And now, more exclusive content to Power Lunch. It is a list of the most loved stocks by Wall Street analysts this year, and which ones of those are really winning. Here's how we do that. At the beginning of the year, I compiled a list of stocks that were on 3 or more top picks lists from Wall Street banks. 3 or more analysts had to have them on some kind of best stocks of the year. We tracked them all year long. And here are the top 3 heading into the end of the year. That was supposed to be drum roll. Number 3, First Solar. It was on 3 top picks lists. It has done great. It's up 61% so far this year. And it's rallying today on Alphabet's buyout of what we just talked about, that AI energy power deal. Next up, a bigger name. Alphabet, the one that was the buyer today. Alphabet was on at least 4 top picks lists coming into the year, and it performed like a top pick, up 63% this year. But the top pick of them all this year, Kelly, was also one of last year's red hot stocks, and we never talk about it.
How I Met Your Aerospace.
That's right, How I Met Your Aerospace. How Met Aerospace, the Pittsburgh-based aerospace company, has been a rocket ship, not just this year, the last few years. How Met, which is on a number of top picks lists, Wall Street got it right, is up 89%. So unless something really weird happens, it's going to be the number 1 stock of all the stocks on many top picks lists. So congratulations to How Met and its investors. I reached out to them, by the way. They got back to me immediately. Thank you, but no thank you. It's a quiet company.
So did you see which ones? I love this because it tells you, and I can imagine these strategists, we always, say, oh, that strategist wrong again. They did a great job with these picks. Were there top picks that did not? Okay.
GitLab. GitLab. I don't even know the ticker, GITLAB. So I track all this with Mike Bloom and some people here at the company. We have this huge FactSet spreadsheet, and then I whittle them down to 3 or more. Most did well, but GitLab was on 3, I think, top picks lists, and it was down like 32% this year.
Still.
But How Met Aerospace, they're quiet. You're welcome anytime on the show, by the way. There you go.
I love it. We'll be back after a break.
flag a couple weeks ago around San Francisco highlighted a company called Cytokinetics. And guess what? They had a positive drug trial result today, and that stock is up just over 6%. Not a huge pop, but we talked to the CEO, Kelly, and a nice win there for people that are, by the way, it's a heart drug. So we hope it does good.
Win for the investors, win for the patients. A lot of winning here today. Thanks for watching Power Lunch, everybody.
Speaking of winning, Closing Bell starts right now.
All right, guys, thanks so much. Welcome to Closing Bell. I'm Scott Wapner, live from Post 9 here at the New York Stock Exchange. This make or break hour begins with another stellar year for stocks. The third in a row, begging the question, can this bull market stay strong again in 2026? We'll ask our experts over this final stretch. In the meantime, we'll show you the scorecard here with 60 to go in regulation. We're green across the board, as you see. Pretty good day led by the Russell 2000. Financials, materials, industrials among the best sectors today. And how about some individual names? NVIDIA, Tesla, Micron all having a pretty good one. Citigroup is leading the banks higher. Bitcoin's up. Gold and silver hitting new record highs. So a lot of positive stories as we begin this holiday shortened week, which leads us to our talk of the tape. What 2026 will hold for your money? Let's ask our panel. Everyone here at Post 9 today. FundStrat's Tom Lee, Hightower Stephanie Link, and CIBC Capital Markets Chris Harvey. Tom and Steph, both CNBC contributors. One and all, it's good to have you right in front of us on the desk today. All right, Tom. So, 2023, we turned in 24%. 2024, we turned in 23%. Pretty good this year, too, 17%. Next year, we fill in the blank with what sounds reasonable to you.
I think it's still possible to have a double-digit year. There have been 12 times in the last 100 years where markets posted 3 years of 20% gains. This year hasn't finished yet. Globally, half the time markets do even better in the following year. So I think next year is a year where the debate's going to be, is the bull cycle over or is it going to extend? I think it's going to create quite a lot of volatility in the first half, but I think GDP growth stronger. We have a dovish Fed. Valuations are reasonable, so I think we end up exiting very strong.
Why a lot of volatility in the first half then?
Part of it is the Trump tariffs could get overturned. There is a possibility of an extended government shutdown. The nomination and then confirmation of a new Fed chair is going to take 3 months. That could be very controversial. I think all of that happens in the first half of next year.
How's that sound to you, Steph?
I think that sounds really great. The economy is on solid footing. We've been talking about that all year long. Last week, we got some really encouraging data with regards to weekly jobless claims. Inflation came in a little bit better. We've talked about the H8 Federal Reserve loan growth lending. That's actually at a 9-week high, all-time high for loan growth. That's very bullish for activity overall. The industrial metals are at all-time highs. And you have global central bankers, including the Fed, getting more and more closer to the neutral rate. That's a good thing. And Fed cuts take a while. There's a lag impact, and I think that's going to bode well for next year. And then you have the one big beautiful bill. $150 to $175 billion going into the consumer's hands, going into corporate America, so CapEx continues. You add it all up, and I think you have double-digit earnings growth. There are some numbers out there that are a little high, like 16, 17% in earnings growth. I'm not there, but I do think you're going to see low teens.
Mr. Harvey.
I think high single digits is reasonable.
Single.
I can't get to 10%, 12%, 15 just yet. Right. One of the things that Tom said, I agree with wholeheartedly. The first half, you're going to see a lot more volatility than you have seen in a while. I think people are sleeping on the macro risks, be it USMCA, be it the transition with the Fed. If you listen to Powell, now he wasn't cocky about this. He was very humble. But basically what he said is, I'll see it at the book signing. We have growth higher, we have inflation lower, we're back to neutral. We don't need to do anything from here. And 6 months, if you don't cut rates for another 6 months, that's an eternity in the financial markets. And then the last thing is, I think corporations are going to, after a good year this year, they're going to manage down expectations. As you manage down expectations, that puts a little volatility to the marketplace. And lastly, risk is priced very, very expensively, either in the equity markets or the credit markets. It doesn't take much to upset the apple cart.
You want to respond to that? Because it seems like, if not a step-by-step counter in some respects to your view, it certainly is enough of one. I mean, there's going to be more volatility. We're underestimating, maybe too complacent about macro risks. that are out there, among other things. What do you say?
I mean, I feel good about the macro environment, all the things I just said. And I think it is a consumer that has been resilient. We've been talking about the consumer forever, how they have hung in there. Yes, it's the high end, not the low end. That tends to be the case on a regular basis, unfortunately. I don't think the AI infrastructure CapEx cycle is going to change in 2026, and that's fueling about 3/4 of the GDP growth. And I do think that we always have a wall of worry. And I've said it, you've heard me say it, Scott, I worry when I don't worry, because that means that we're complacent. I think there's a lot that people have on their minds. I think we're going to be able to get through it because fundamentals at the end of the day, they run the show. And if you do have an economy that grows 2.5%, 3%, we're growing north of that now. But if you have an economy that's growing 2.5%, 3%, typically that's been a 10% earnings growth. And I think we're going to be a little bit more. And you have lower interest rates. By the way, you have lower gasoline prices. You have lower egg prices.
But address the valuation issue that stocks are. You want to go there?
Well, it's all about earnings, though. It's if I think if earnings are growing in double digits, then I do think the valuations are very attractive, especially in other sectors beyond tech.
Yeah, and we have to keep in mind the equal weight S&P 500 PE is 17 times. It's lower than it was 5 years ago. So the market actually has derated in the last 5 years because of these black swans of the shutdown, inflation surge, fastest Fed hikes in history, et cetera. So actually the equal weighted market is cheaper. I don't think risk is actually that expensive.
Listen, so let's turn it to small caps for a second. Just talk about risk. There's two indices for small caps, Russell 2000, S&P 600. Both small cap, they should perform pretty much in line with each other. Russell 2000 is outperforming by 8% this year. Russell 2000 outperforming by 8% because S&P 600 is a high quality index. The things that don't earn money, the things that have excessive beta, all really driving that marketplace. So I see, if you look at IG credit spreads, less than 80 basis points. If you don't know that market, that is tight, right? If you look at the S&P high beta index, it's up 35%, 34, 35%, double of what the S&P is. I see a lot of froth, right? There's a price for risk. It's here. I think the price for risk is down here.
Interesting. I mean, it is one of the key questions, no doubt, is whether the broadening story that we've been talking about has legs. And what do you need to reach some of the loftiest targets from strategists that are out there? I mean, the top one's 8,100. Dom Chu joins us now. I mean, it's a nice range, Dom. But 81's the top, as you show right there.
Yeah, that's right. 81's the top. That's John Stoltzfus over at Oppenheimer right now. So that implies a pretty decent sized gain. And the lowest is still bullish, only about maybe 4 or 5% higher than current levels right now. But that's Savita Subramanian over at Bank of America. So 7,100 is the low end of the 15 strategists that we've surveyed here at CNBC. 8,100 is the high end. The middle, 7,629, actually implies upside of just about 10% or so from the current levels that we're at right now. So generally speaking, we could get to, if we get to the average target price, a double-digit gain for the S&P 500 by the end of next year. As for whether or not we can see the contributors for that move higher, yes, it's always been about Mag 7, but these days we're seeing a little bit more relative strength in other parts of the market that imply maybe a broadening out trade. Check out the small cap ETF, which is already up 21% on a year-to-date basis. The mid caps are up about 11.5%. Underperforming, though, the S&P 500 at 15. So the small caps getting some legs and some steam. That could bode well for the broadening out trade. As for the sectors that could be interesting here as well, check some of these out. Because over the last 3 months, it has been healthcare, financials, and industrials that have been among the star performers on a 3-month basis. So do they carry some relative strength or momentum over the last 3 months into the early part of 2026? That's going to be key as well. As for some of the individual industries that are leading the way higher, speaking of the broadening out trade, the XME is the Spider Metals and Mining ETF. That's already up about 89% so far just this year. The ITA is Aerospace and Defense, which is 51% higher, and the NASDAQ Biotech ETF has been a standout, up 30% so far. So as we talk about the broadening out trade, some of the best performing industries and ETFs out there that track them are not tech or comm services related. There are other parts of the market, so that's going to be a real key for that trade in 2026, Scott. And by the way, for more on that story, just head over to cnbc.com/pro. Subscribers get all the context and detail around those big calls out there. I'll send things back over to you, Scott.
Yeah, that was great stuff, Dom. I appreciate you for that. That's Dominic Chu. So you've already had a good amount of broadening. The idea that the market hasn't been broad is a fallacy, really.
I mean, yes and no, because when you look at 3-year stacked, it's still Mag 7. And so I think it makes sense to not just look at 2025 by itself, but how have stocks done since the end of 2022. To me, there's a lot of room for cyclicals to really outperform, including financials, because the ISM's been below 50 now for almost 3 years. That hopefully turns up above 50 next year, and we get a pretty, I think what I consider a cyclical broadening of the market.
To outperform tech?
Yes, and Steph and I were talking about this, that I think tech earnings visibility is still good, but the multiple expansion story doesn't have as much upside as industrials or financials or energy or even basic materials.
It's funny because you just bought more Meta.
I did.
Like this morning or yesterday, right?
This morning, yeah. I still like it very much. It's still down 6% from its highs. I still think that they win from AI and what it's going to mean for their ad business and for their messaging business and customer apps business. The metaverse cost cuts are $5 billion in savings annualized. Gives them $2 a share, again, annualized in earnings. I think this company can actually deliver $36 to $38 a share by 2027. That puts this thing at 18 times earnings, and it's growing earnings at 20% and revenues at 26%. All that being said, so it's a big position, top 5. All that being said, I am underweight other mags. I really only own Amazon, very small Microsoft, but I do think that financials are going to be the sector leader next year because we're not pricing in on a valuation point of view. We are not pricing in all the deregulation that is going to come and the excess capital that is going to be returned to shareholders and, by the way, lead to loan growth, which is why I look at the H8 data. It's really important to see what banks are doing. If the banks are lending, that's going to help the entire economy as a whole us grow, and these stocks are not expensive. Capital One is at a 12 times multiple. You know, even Morgan Stanley, expensive, right? 17 times. Bank of America, 1.4 times book. I think that there's a lot of runway left to the financials, and that's the sector that I've been overweight for a long time, and I continue to be.
You agree with that?
We like parts of the financial. We really liked the financials about a year and a half ago. Now we're just being a little bit more selective. I agree with some of the broker-dealers, some of the credit card companies, relatively cheap. I think there's some upside.
But not the big banks?
Big banks are fine. I just don't think they're an overweight at this point in time. Right? They performed exceptionally well. Actually, JP Morgan's outperformed a big section of tech over the last 3 and 5 years. So it's performed, right?
But why wouldn't you be overweight that group? I mean, if you think that earnings are going to stay strong, the economy is going to be good, you're going to get more deals, you're going to get more IPOs, all of that, deregulation and everything. That feels reasonable to expect all of that.
It's reasonable. I think a lot of it's in the price. I think they need to either pull back or consolidate. And if they do either one of those, we'll take a look at them. But I agree with Stephanie. The deregulation story has more to play. But in the banks, I just don't think it's the right time to do it. They perform so well. Valuation is fine. The underlying fundamentals is fine. But there's nothing undiscovered there where we're saying, got to own the banks.
Well, we haven't had a net interest income cycle in about 10 years. And the steep yield curve will be very beneficial for that.
Yeah, but I thought you talked about yields coming down.
We're seeing a steepening in the yield curve.
I know we are now. But I mean,
that's very positive.
Well, because the front end of the curve's coming down because on expectations of rate cuts.
That's okay. I mean, rates are coming down on the short end. Probably 10 years kind of sits here. Maybe it goes down a little bit. But I still think you're going to see a steepening yield curve. And that will help a big part of the bank's earnings, which is almost 50 to 60% in some big banks' cases. That's their revenue generation. So I think earnings estimates are going much higher, and that's why I want to be overweight.
All right, well, yeah, you got some.
I was just saying, just to add to Stephanie's point, I think tech-forward banks that are using AI also are big margin stories because employee compensation is their biggest expense. I think banks are going to look more like tech stocks in the future, where they use AI to reduce employee dependency and earn the same money and their multiples go up.
All right, well, speaking of AI, one of the critical questions is, can we get past all the bubble banter talk? Well, bubble banter, really. Kind of redundant if you say banter talk. Deirdre Bosa joins us now with that critical question because we're obsessed with it now. I wonder what early 26 is going to bring.
We're probably going to be obsessed with it for some time, right, Scott? I mean, the AI trade, for now at least, in the last few days, back on its feet, but none of the big questions actually went anywhere. This data from SimilarWeb, it gets at one of the most important questions in the whole trade, OpenAI versus the Google AI universe, not just on models, but across the stack and what each one represents. Now, from January to November of this year, OpenAI gave up a little bit of market share. Google, though, grew its market share from about 6% to 15%. This suggests that Google has the momentum and is finally converting distribution into real gains. Now, it's also quietly challenging NVIDIA on the hardware side with its custom AI chips known as TPUs, and that could impact the entire cost structure, what we know of it today in the AI trade. Now, going into next year, there will continue to be questions around whether OpenAI can meet its own ambitions and obligations while competing with an incumbent, Google, that controls the entire pipeline. Something else I want to mention, Scott, there's this really interesting debate going on at the very highest levels of AI right now. It's playing out on X between DeepMind's Demis Hassabis at Google and Yann LeCun, who just left Meta. These are two of the most prestigious people in AI. Hassabis is arguing that today's scaled models, they're already on a credible path to general AI, while LeCun is saying the current approach is a dead end without a new architecture. So if Hassabis is right, scale, chips, infrastructure, those things keep winning. But if LeCun is right, a lot of today's CapEx is going to look premature and the payoff gets pushed out. And that is really the central question on the bubble, right? Can we justify all of this spending?
Yeah. And maybe we don't know the answer for a while. Dee, thank you. Georgia Bosa, Chris, you say that the tech bubble does not pass our litmus test.
Yeah. So again, it gets back to something like JP Morgan banks, which is outperforming. Go back to late 90s and the banks really underperformed. Here, the banks are actually leading the way. Multiples that we're seeing, still not excessively high. You go back to late 90s, whether it's Oracle or Cisco, you're not seeing it. More importantly, let's go to, can you fund these risky endeavors? If you go to the credit markets, anything not named Oracle, you can go out and you can still fund. And so this market is still rather healthy. Valuations are not high enough at this level. We don't see the frothiness that we saw back then. And the commercial aspect is so much better now than it was in the late 90s.
So you think the Oracle situation or issue or whatever is idiosyncratic to itself?
That's what the market's telling you. The market's telling you that Oracle is very idiosyncratic. If you look at the credit spreads, if they came to the market, you'd be questioning how much can you bring to the market, at what spreads. If anything else, any of the other hyperscalers came to the market would probably not really think about it and digest more or less anything that they brought to the market.
You think we continue to have dispersion among these stocks? Yes, Alphabet is up 63% year to date. NVIDIA is up 37%. Microsoft is, an underperformer slightly to the market, as is Meta, as is Apple, as is Amazon. Does this continue?
Scott, I'm going to say something that's not very popular, but I still think they trade as a basket because they do all have linkages to the same theme, but at different points in time, some will lead versus the others. And so I have clients that do mean reversion among the Mag 7, but I think that they're largely one complex.
Okay.
I hope we get mean reversion in the names that I own, because Meta obviously has a ways to go, but Amazon does too. Out of all the Mag 7s, that one to me has been the most surprising, that it just can't get out of its own way.
Do you agree with what he said, though, that you're going to get back to trading like a group? Because the stocks would suggest otherwise.
Yeah, no, I actually think that at any given point, you have a couple of leaders and a couple of laggards. And I think I'm betting on that the fundamentals are strong enough in the laggards that they will mean revert next year. That doesn't mean that Alphabet is going to fall 50%, but maybe it just trails for a little. Maybe it takes a pause. Same thing with Broadcom, as you know, I've said that before. Like maybe it just takes a pause because it has crushed NVIDIA over the last year. And that's okay, but the fundamentals are still very, very strong, sound. Estimates are going higher. And when estimates go higher, no matter if these stocks take a pause, eventually the stock prices catch up with the earnings revisions.
Last point to you. How will these trade?
We like the software space. We think it's more selective. It's not over. And we think the best risk reward is in the software space.
All right, guys. Good holidays to everybody. Look forward to many conversations in the new year. Thanks for being here.
Thanks, Scott.
Let's send it to Steve Kovac now for a look at the biggest names moving into the close. Hi, Steve.
Hey there, Scott. Yeah, shares of Tesla, they're gaining almost 2% after the Delaware Supreme Court ruled on Friday that Elon Musk's pay package must be restored. Also this weekend, Musk said those robo-taxis were unaffected by the power outage that disrupted Waymo operations in San Francisco. Meantime, Dominion Energy shares sinking over 3% after the Trump administration paused the leases of 5 East Coast wind projects, including Dominion's Coastal Virginia offshore wind project. Interior Secretary Doug Burgum said the move was due to needing some time to assess possible national security risks. And shares of Paramount Skydance up about 3% after the company said it guaranteed Larry Ellison would pay back an amended offer for Warner Brothers Discovery, sending those shares also up 3%. WBD has already accepted an offer from Netflix, and P-Sky notably did not increase its bid as part of this latest development. We see Netflix shares, they're down about 1%, Scott.
All right, Steve. Thank you, Steve Kovac. We're just getting started here. Coming up next, Renaissance Macro's Jeff DeGraff. He's flagging 3 sectors that he says don't touch right now. He'll join us right after the break. Welcome back. The charts are telling a bullish signal for stocks. We're joined now by Jeff DeGraff. He's chairman of Renaissance Macro. It's good to see you, Cowboy.
Good to see you, Scott. Thank you.
Nice backdrop.
I'll tell you, if you're coming out west, don't come to ski. I'll tell you, it's better to suntan than it is to ski this year. So
I heard actually there was no snow, but there's beauty. That is for darn sure.
Indeed.
All right, so I painted this as a bullish signal in the charts for stocks. How so?
Well, look, I think there's a couple things that are happening that's bullish, and the first is that real yields are contracting off of the inflation print last week, and I think one thing that investors historically underestimate, even though certainly it's on their radar, is just the importance of inflation. Inflation is far more important than growth, and so a contraction in inflation, if we're going in that direction from the trajectory of the data last week, certainly sets up bullishly for 2026. So we're hopeful. We're not in the zone yet where it's really a lock, but certainly the trajectory is going in the right direction, and we're hopeful that is the tailwind for 2026.
You know, when gold had been going up so consistently, it made people nervous. Like, what's the message in that? Is it something to be worried about? You're suggesting that global metals looking good is a bullish sign. Are you talking about another record today, for example, in gold and silver? Are you talking about those as well as some others?
Yeah, it's everything, Scott. And I'll be honest with you, in terms of squaring that with the inflation picture, I'm not sure, we totally understand what exactly is going on with that narrative. But I would say look at aluminum, look at steel, look at copper, obviously look at gold, silver, look at palladium. They're all bullish breakouts, and most of them are just coming out of these big bases. So I think there's more to go there. Certainly, I think it's as much about most likely what we're seeing from an improvement in global activity. And you hit the nail on the head, which is these are global in nature. This isn't just Freeport breaking out. In fact, I'd say Freeport's one of the laggards. We're seeing a lot of bullish breakouts in China. We're seeing it in Europe. And obviously, we're seeing some of those here in the U.S. as well.
Software has been an underperformer. We talk about it all the time because of the relationship that it has, not only in the AI trade, but to the underperforming relative to semis, for example. It still looks bad, according to you.
Yeah, it does. We had confirmation. We had a bearish signal that took place back in July, and we had confirmation of that this last week. And I know all the news circling around Oracle, but it's far greater than that. And so, until we can see the whites of their eyes that we think that there's some type of pause or some bottom forming there, we're just staying away from those names. And I think refreshingly, the semiconductors have stayed firm. They look good. Comm equipment names look really, really good. They're actually leadership in the tech space. So we'd focus our efforts there. But it's also an interesting message because we're seeing exactly the same thing, not just in tech, but we're seeing it in everything, where I can show you charts that are actually outright bearish, not relative laggards, but just outright bearish charts. And I can show you at the same time outright bullish charts within the same sector. That's everything from discretionary to industrials to tech to staples and the like. So it's really a bifurcated market. I don't think that's bad, but certainly there's opportunities on both sides.
What's Bitcoin telling you? It's hasn't looked good to say the least. But what do you think the charts are saying?
Well, I think all the crypto's under pressure. Bitcoin's actually the best one out of all of them. So, we keep our eye on that. Obviously, it's a little bit more established. You broke the qualitative uptrend line. I think that's bad news. The 50-day crossed into the 200-day. You have to take some artistic license to call it an uptrend still. So we think at best it's a neutral trend. We'd actually put it in the downtrend camp. The good news is the ETF flows, as we've seen them and as we measure them, have gotten excessive outflows, I should say. And so usually you find some type of relief on a very tactical basis there. So I think we're set up for a decent year-end rally in Bitcoin. I don't think it trades much higher than 100,000 if we can even get that. And we'll be using that as an opportunity to lighten up on positions and frankly get short some of those.
Can you have a durable equity market rally if Bitcoin remains sketch?
Yeah, it's a good question. I mean, it's far more correlated to the NDX, and I think what we're seeing is kind of this broadening. So I do think you can. It probably doesn't have the same type of fireworks that it would otherwise, but I think you can still have, with the broadening of the market, a decent equity market in 2026 without having to have Bitcoin. Now, if you're going to tell me Bitcoin is going to trade to 50,000, then I think we've got a problem. If it's going to trade down into the mid-70s and stabilize, I think we're okay with that.
All right. We'll see you. Have a good...
Happy holidays.
Yeah, you as well. We'll see you in the new year. Enjoy yourself out there. That's sun and...
Thank you.
Maybe no snow, but nonetheless, beautiful country. All right, still ahead, former Dallas Fed President Richard Fisher. He maps out his forecast for rates, who he thinks maybe should be the next Fed chair. See what he says next. Welcome back. Two of the most anticipated questions of 2026 are who will be the next Fed chairman and how many times will they cut rates? For some clues, let's welcome in Richard Fisher. He's the former Dallas Fed president, now a senior advisor at Jefferies. It's good to see you. Welcome back.
Thank you, and happy holidays to you and everybody at CNBC.
We appreciate you. Thank you. All right. Would you cut rates in 26 if you had the vote?
Depends on what the numbers show. We got some rather dodgy inflation numbers recently. They're incomplete. You're hearing, if you talk to business leaders, that they're going to try to move prices a little bit more aggressively next year, at least ones I talk to. And we also hearing that we're getting a lot of propelling coming from the AI CapEx investment, which seems to be carrying a lot of GDP. All that needs to be settled out next year. So I would wait and see. I don't think there's any hurry. I also don't think, under the current structure of the Fed, there's a predisposition under Chairman Powell's leadership to necessarily commit already to moving next year. Other than Myron, I doubt you're going to see people advocating until we get better data. And we just haven't had a full set of data. The inflation data we got is only good from the 14th of the month onward. So we didn't get a full month view, and certain sectors are left out. It looked good. We'll have to see if that's true.
You referenced Mr. Myron, who said in an interview that the Fed risks recession without more interest rate cuts.
Yeah, I don't buy that.
He said, you don't buy that?
No, look, he is, by the way, a very nice man. He conducts himself, from what I understand at the meetings, very respectfully. But he's just carrying the water for President Trump. So I don't buy it. And I do think the president would like to have, if it doesn't work, and I pray to God his economic program does work from the standpoint of deregulation, et cetera, and the good stuff he's doing, I hope the economy continues to grow. But it would be nice to have a fall guy, and obviously they're setting up the Fed to be a fall guy, which I don't think is fair. I think the Fed's done a pretty good job here, particularly after cutting rates recently. But as you saw, Scott, on your previous interview, the yield curve is steepening, and we're not seeing the 10-year come below 4%. That's a question of Treasury auctions and who feels comfortable with the way the balance sheet of the government's running, income and expenditures on interest. So I don't think it's fair to blame the Fed, as he seems to be predisposed to doing, until you actually see what the outcome is. We don't know what the outcome is yet.
The challenge, I guess, certainly one of them, is the idea of letting the economy run hot, right? Run it hot is out there, sort of in the zeitgeist around the market and what the Fed might be willing to do. Because if you're going to get a tremendous productivity boost from AI, you can in many ways offset the idea that you're going to have some runaway inflation by letting it run hot, a la Greenspan in '96, in which we're on the cusp of the 30th anniversary of that. And I should also mention one in which Steve Leisman is going to explore in much deeper form tomorrow. Versus, you described yourself the last time you were on with me, quote, I am, I always will be a hawk.
Right.
So versus this inherent feeling that you have of always feeling that way because you're afraid of what would happen if the effects of inflation were to get out of control once again. I mean, how do you square both ideas?
Well, first of all, Scott, remember, I also said, and half jokingly, but jokingly, that doves are members of the pigeon family.
You did.
Ornithologically. So I don't want to be a pigeon for anybody. And that's what my reference was to being a hawk. I want to make sure the Fed does its job to make sure inflation or deflation doesn't raise its ugly head. And every president, as I've said to you many times, every politician worries about jobs over anything else. The job of the Fed is to keep the balance. We do still have very low unemployment, but we keep hearing that things are getting worse, no hiring, retaining but not hiring new numbers. The numbers have not been strong. So we're just going to have to see what the balance is, Scott. I mean, the Fed wants to do what's right. And that dual mandate makes their job, as the chairman has said, and everybody says that serves on that committee, it's a tough decision right now. So I wouldn't pre-commit to anything as we go into the new year until we get more reliable data, and we don't have it yet because of the shutdown.
But what if I said to you what seems clear in some senses, we're going to get a massive productivity boost. We're already seeing signs of that.
Some of it,
Inflation has already come down a tremendous amount, is going to continue to do so. And maybe it doesn't necessarily have to get down to 2% because of the productivity boost you're going to get on the other side. And there is reason to be a little concerned over the displacement of jobs related to AI and some of the softness that you're seeing. So it seems clear to lean heavily towards the labor picture, and you can figure the other one out because you're going to get some boosts that you may not fully realize the magnitude of yet.
Scott, businesses do not depend on Fed funds to finance themselves. Operating businesses depend on credit cost, and they borrow in the markets, particularly the large ones, or the smaller ones borrow from banks. That's related to the longer part of the yield curve. It's not related to Fed funds. It's a small portion of how it affects the 10-year Treasury, for example. Mortgages key off the 10-year Treasury. Businesses key off of what they can borrow in the marketplace. And it does help that we've had very narrow spreads, although some of them have widened out a little bit here. But the base rate is not the Fed funds rate for operating businesses that commit for CapEx, et cetera. So I don't think what you really have to worry about here is our government finances. We're taking in a little bit more revenue. Everybody's now beating their chest. We took over $5 trillion in revenue, but we're spending over $1 trillion in interest costs on the U.S. government debt. That doesn't seem to be reining in as much as we all hope it will.
Okay.
And if that's determined, that will influence the way businesses look at the credit markets, in my view, for what it's worth.
I have one last question for you. When you're at those fine cocktail parties down in Dallas, and I know you are, and people ask you, Richard, who should be the next Fed chair? Who do you think it's going to be?
Right.
You tell them what? Let us into the room. Well, who is it going to be?
I tell them that whoever it is going to have to be careful because they cannot get this job unless they commit to the president's agenda. So I do have feelings about all of them. I like them all. I do think Waller probably is better experienced at the Fed itself and understands how it works, better respected by the rest of the committee. Reeder, nobody knows fixed income markets better than he does. He's brilliant, and he's a friend, by the way, so I'm biased. And then if you look at the other two, I've served with Kevin Warsh. He's matured a great deal since he left as a young man on the Board of Governors. And then, of course, we have Mr. Hassett, who's been very close to the president. So what I do worry about, I want to see somebody who's strong enough to just stand up to the president if necessary. And I don't think anybody's going to get the job unless they've committed to follow his agenda, at least initially. So do I have a favorite amongst the four? I don't. But that's the way I look at all four of them. And other than nominating you, Scott, I don't favor anybody.
All right.
Which would be a disaster.
Very diplomatic. That's probably why you get invited to all those fine cocktail parties in Dallas, as I mentioned. Richard,
we are growing, but we are growing like topsy down here, and 4% interest is not hurting the Texas economy.
I know that. Happy, healthy, and we'll see you in the new year. I look forward to it.
Happy holidays, Merry Christmas to everybody. Thanks for having me.
Well. Yeah, that's Richard Fisher. Up next, we track the biggest movers as we head into the close today. Steve Kovac is back with us, standing by. What do you see?
Hey, Scott. Yeah, we have a space stock skyrocketing on a new satellite contract and a fresh bid sending a uniform supplier higher. We'll give you those moves and more coming up when Closing Bell returns after this.
We're about 10 from the bell. Let's get back now to Steve Kovac for a look at the stocks he's watching. Top of the list today's what?
Yeah, Scott, Rocket Lab, those shares are popping over 9% after the company said its new $860 million deal to build satellites for the U.S. Space Force is its largest single contract ever. Space stocks rallied last week on news of that potential SpaceX IPO, as well as President Trump's executive order that aims to create a permanent U.S. base on the moon. Also, shares of uniform supplier UniFirst soaring 18% after Cintas, a big maker of workplace products, submitted another offer to acquire it. The total value of the offer amounts to $5.2 billion, and the fresh bid follows offers by Cintas in 2022 and again earlier this year. And finally, Stanley Black & Decker higher by about 3% after the toolmaker agreed to sell its aerospace manufacturing business to Howmet Aerospace for $1.8 billion in cash. Stanley will use those proceeds primarily to pay down debt. Scott?
All right, Steve, thank you. Up next, Bitcoin losing some steam as we head into the close today. Tell you what's driving that action. Plus, Capital Area Planning Group's Malcolm Etheridge standing by. He'll help us break down the final moments of this day. Market Zone's next. We're now in the Closing Bell Market Zone. CNBC senior markets commentator Mike Santoli and Capital Area Planning's Malcolm Etheridge are here to break down these crucial moments of the trading day. Plus, Mackenzie Sagalis is watching the volatility in crypto. Deirdre Bosa is here with what is driving the moves in Uber and Lyft. Mac, to you first, and crypto.
Scott, Bitcoin and altcoins like XRP and Solana are in the red. Ether slipping below that 3K mark, and Bitcoin trading under 89,000. It's about 30% off its October all-time high. Spot Bitcoin ETFs still aren't offering much support. Institutional flows remain soft. And even with the Fed now cutting rates, risk appetite is cautious in the crypto markets. That whole Bitcoin is digital gold story isn't really showing up either. The safe haven bid is going to metals, with gold at another record high today. But crypto-linked equities are bucking the dip in tokens. Circle, Bullish, Coinbase, and eToro are all trading higher. And Strategy, the biggest Bitcoin treasury name, sold a batch of shares last week and added another $750 million to its U.S. dollar cash reserve. That's a sign that they're building a cushion in case this turns into a longer crypto winter, Scott.
All right, Mac, thank you very much for that. Deirdre Bosa, Uber, Lyft, blackouts, Waymo, tell us more.
All the things, yes, they are higher today, the ride-sharing complex. Investors are maybe reassessing the autonomy trade a little bit. There was Waymo's weekend gridlock here in San Francisco, and that really kind of makes the contrast pretty sharp. Uber and Lyft, they aren't carrying the regulatory or the reputational risk of running their own fleets. Instead, they're partnering with many different players, positioning themselves as the aggregators. Now, the latest partnership is China's Baidu to test Apollo Go robotaxis in the UK next year. Of course, Scott, this has proven to be a volatile trade. The rideshare stocks, they typically fall when we get progress from a Tesla or a Waymo that doesn't include them. Today, though, it's in their favor.
All right, Dee, thank you. Deirdre Bosa. Malcolm, it's good to have you join Mike and myself here. What's your thought here as we close out this year? A few trading days left.
Yeah, I think it's interesting that as much as we've had conversation over the last couple months about whether the broadening trade is meaningfully going to actually do something. I saw the entire A block, and that was one of the themes you guys were discussing. Yes, it was a good year for small caps and others through the last couple of months, but it's interesting that the last few days toward the end of this year, it's Amazon, it's Nvidia, it's Microsoft that have gotten up off the mat and done 2-3% in just the last couple trading days, setting up for the Mag 7 to carry us toward our third 20% return in a row for the S&P 500.
What about into the new year? Does it just remain that way?
I think it does. I think the IPO market is probably going to keep enthusiasm where it is heading into 2026, especially in the tech space. We're talking about Anthropic, we're talking about OpenAI, which both may or may not actually make it out in 2026, but there's probably a ton of other tech names that will, and so that enthusiasm will continue to flow through the Mag 7.
Mike, I like that thought, that there's going to have so much activity around that we're just going to be focused on this no matter what we want to believe.
I do think that's true. I mean, it is the sort of the beacon that's out there that the rest of the market's been chasing. I mean, I think you can still have it be a market that periodically does allow some catch-up moves. Today, you are seeing the industrials do pretty well. Banks, again, leading. But what's fascinating, first of all, if Malcolm thinks we're getting another 20% up year, I think we got to do 3% in the next 6 days, at least without dividends. But hey, anything is possible because the market is kind of acting right now kind of the way it's supposed to. When we've gotten through this news slalom of the last few weeks in terms of the jobs report and all the big earnings are out of the way, and now it's just kind of about year-end flows tacking on. VIX at 14 tells you the market's going to be closed almost as much as it's open in the next week. I think that's all a decent base, but I do want to remind folks, we were trading at this level October 29th. And so it's not as if you've kind of really had a runaway to the upside, and that might be good going into next year because I do see the makings for people to start get overexcited again. The space stocks are going nuts, as you were mentioning just a little while ago, the quantum stocks. And so I do think it doesn't take much for the market to go into silly mode here.
You know, what about the risks, Malcolm, into the new year? What's the most pressing one, do you think?
Frankly, I think the financing structure of the data center build-out that has been underpinning so much of this AI trade is probably where a lot of really telling that the likes of Microsoft and Alphabet and Amazon and others don't actually want to own that debt don't want to own those assets on their balance sheet, and that they're passing off the leasing structure to other companies, these neo-clouds that have been coming along. And frankly, I think there's a chance that a lot of that will start to unravel in 2026.
Starts to unravel, that's going to be a problem for this trade. Let's not kid ourselves, right?
It should. And again, those companies are somewhat insulated by their core business, but you do have this risk out there that the appetite for capital is going to be so voracious that at least at times, overtakes the market's willingness to give it on friendly terms. I do think the other thing going on with the hyperscalers is they're starting to look cheaper on a PE basis, but they're kind of spending down all their free cash flow. So it's a different equation. It used to be, oh, they seem expensive, but all their earnings are free cash flow. And now it's the other way around. They're looking not as expensive, but that's because they're on this treadmill of spending. So I think it's just one of the wild cards into next year.
Most exciting part of the market outside of tech for you, Malcolm's what?
Yeah, I think financials. I think if you look at the names, Goldman Sachs, Morgan Stanley, JPM, all three of those companies have participated in all the big M&A transactions that have happened this year. They've really been the ones to help to organize those deals. And so I think that those three names, which I don't own any of the three personally, I think they continue to do very well in 2026.
All right, well, they're going to ring the bell. We're getting closer to 26. Still got a few trading days, obviously, left to go. It's a holiday-shortened week. Started this one out pretty strong. Nice gains across the board. Russell, bottom of your screen on the far right there, is the one that is doing great today, up better than 1%. Mike, thank you as always. Malcolm, be well. We'll see you soon. Does it for us. I'll see you tomorrow into OT.
Well, that's the end of regulation. Global X ETFs ringing the closing bell at the New York Stock Exchange. KMK Financial doing the honors of the NASDAQ. We'll be talking to them a little bit later this hour. Stocks higher, risk on. S&P and NASDAQ up for the third straight session. The Russell 2000, the outperformer today. With today's gains, the S&P 500 is less than 1% from a fresh all-time high. Financials, materials, and energy were the leaders. In fact, all the sectors were higher except for staples. That was the only sector to end in the red. The big action was in the commodities today. Gold, silver, copper, all hitting new highs. Gold and silver now tracking for their best years since 1979. Oil also jumping